Sorry about that. So everyone, just to let you know, we are now recording. Don't worry if you're at home and you just started watching this video now. We've only talked about this one slide basically, and we're reviewing the balance sheet. So assets, and we'll look at some ratios that use these different assets today. But the big breakdown is current assets and non-current or long-term assets, right? And you guys should be familiar with your cash and accounts receivable and inventory. And then your most common long-term assets are things like property, plant, and equipment, PP&E, and goodwill. If the company's been acquiring other companies, you might see some goodwill. And then how do those assets come to exist? How do you get assets, right? Assets don't appear out of thin air. You've got to somehow get the funds to purchase those assets. And so that's where the liabilities and equity comes in, right? The company is taking other people's money and using it to buy assets. And so if it's on the liability side, you're talking about debt. Oh, I need my red pen here. Sorry. I like the red pen more. Okay. Debt. And if you're talking about equity, that's stock. That's where the stockholders investment goes, right? So we're going to be looking at ratios that also use debt, equity, assets, all that stuff. So what's a financial ratio? A financial ratio, just to put it simply, it's one number divided by another number. It's nothing scary. It's not one ratio in and of itself is very simple. When we can play some games and do some more advanced analysis with these ratios, but at the end of the day, it's one number divided by another number. Some ratios are going to have only income statement numbers in them. Some ratios are going to have only balance sheet numbers in them, and some ratios will have a mix of both. Okay, and we're going to see all those today. The main measure, if you're looking at a company and you want to figure out how well is this company doing in terms of generating a return, you want to look at net income. Net income, the bottom line of the income statement, that's the primary metric of the return that a company is able to generate, okay, with its assets or with its investment or whatever. And if you were in my last valuation session, you'll recall the residual income model, right? Where we talked about net income as the metric that shareholders use to figure out, is this company earning enough money based on our expectations? Okay. So some of our most important financial ratios, logically, right, by extension, some of our most important financial ratios will have net income in there, because it's like return on something, then you're usually talking about net income. Okay. By the way, if anybody has any questions, just go ahead and, I mean, you can try to raise your hand. I might or might not see it because I'm going to be working problems down on my iPad, so I might not see it. Feel free to just unmute and jump in and ask a question anytime. Although if I hear background talking and like pets barking and stuff, I'll try to just mute you myself. But feel free to unmute and ask a question anytime or make an observation. I'm trying not to go the entire, like every single minute today, because I realized last session, I kept having to shut down people's questions and be like, oh, well, we don't really have to, like that. That's too much of a tangent. So hopefully today, if you do have questions, hopefully we have time for me to answer them better than I did last time. Okay, so now the balance sheet's important too. So net income is really important. What kind of a return is this company generating? What is it earning, right? That's why in finance, they don't even call it net income. They just call it earnings, right? So what's the company earning? But the balance sheet is also super important, because you want to know how much assets is a company using, how big is this company, how risky is it, right? How much debt is it using? What's being held on to for shareholders? We would look at the equity section, right? So we're going to see all this stuff in ratios. And just as one very simple example, right, of why you have to use financial ratios, is 10 million in net income, is 10 million of earnings, is that a lot or not? Well, it totally depends, right? If a firm is earning, 10 million in net income with only 5 million in assets, yeah, that's incredible, right? If you can put 5 million of assets to use and earn twice that, right, in earnings, that's amazing. If you had 500 million in assets, that's a pathetic return, right? Well, pathetic might be an overstatement, but I mean, that's like a 2% right, return on your assets, right? So the reason we have financial ratios is to scale some of this stuff, right? That's the main reason, is to kind of see, what percent of earnings, in assets are you earning, or in equity or whatever. So we'll talk about that stuff. So in general, there are two broad categories of ratios. I mean, there may be more, but the main two categories are profitability ratios, of which we have there are tons of different ratios, but these are some of the main ones that are the most important ones. We have return on assets, we have return on equity, and there are many variations of these that we'll talk about. And then we have turnover ratios. And there's a whole bunch of turnover ratios that we'll get into a little bit. And then the other big category is credit ratios. And credit ratios are looking more at the debt side of things, the capital structure, the riskiness of the company using credit. Can it meet its current obligations? And so within credit ratios, you generally, not everyone totally agrees where things fall in the subcategories, but you generally have liquidity ratios, solvency ratios, and coverage ratios. And we'll talk more. We're going to go through these kind of in this order during this session. So we're going to talk about all these different things. So profitability ratios are looking at, surprise, profitability, and credit ratios are looking at more of the debt riskiness side of things. Okay. Any questions so far? All right. So when we calculate a financial ratio, we usually don't, we may do that in a couple examples today just because it's a relatively brief session, but you usually wouldn't just calculate a financial ratio. Like, oh, let me go look at Microsoft's return on assets. It might be interesting. It might tell you something, but in general, we're always calculating multiple ratios and comparing them to each other. And there are multiple comparisons you can do. You can do time series comparison where you look at the firm over time, right? Like what's the trajectory of, is it getting stronger? Is it getting weaker? You frequently compare competitors or peer firms in the same years. That will be called cross-sectional comparison. And then sometimes for a couple ratios, you might actually have some kind of rule of thumb, like, oh, it should be at least one. All right. And there aren't many ratios like that, but we'll see a couple. That's actually cited down here. We'll see a couple exceptions. But so usually ratios are only meaningful in terms of comparison. There's no such thing as like, well, the leverage ratio you need is 1.67. That's just not a thing that exists. Okay. All right. So we're going to start out with profitability ratios. And unsurprisingly, these assess the firm's ability to generate a return for shareholders. So the shareholders put the investment in. They want to know that the company is doing, good stewardship, is strategic, and is making wise investment choices. So they want to look at how profitable is the firm given the investment that we've put into it, right? Are they doing well or not? What factors contribute to that profitability? So we're going to look at a couple different analyses. Dupont analysis is what it's called, that breaks down some of these profitability ratios into several component ratios. And you'll see that, well, this part of the ratio might be higher, or this part might be lower, and it evens out in the end. Or you'll see companies where all the ratios are strong. But so we're not just interested in how profitable, we're also interested in the why. Why is the company profitable, right? What's driving that profitability? And then finally, how efficiently the firm is using its resources. And that's more in the turnover ratios that we'll get to in the latter part of talking about profitability. So I don't know if this is the proper order to talk about it. In fact, I used to talk about it in a different order, but for this session, I was like, I think this might make more sense. So return on assets. I used to say that return on equity is the most important ratio because when I teach financial statement analysis to various groups, we do it mostly from a shareholder perspective, right? Like what stock should I buy? Or if I'm running a hedge fund, what should I buy or sell? Or, but I think that probably the most core ratio of everything is probably return on assets, because that's the return that the company's generating on its assets, on the things that it owns. Okay. So return on assets, it's really simple. It's how many dollars of net income is the company generating for each dollar of assets that it has. And it's usually expressed in a percentage, and that's it, right? So its financial ratios are very simple. This is the ratio. This is return on assets, net income divided by the total assets on the balance sheet, right? And that's going to give you some dollar per dollar or a percentage return that the company's earning. So for example, I just checked the other day, Apple's 2022 net income, almost 100 billion, right? and its assets were 352 billion. So its ROA is, one divided by the other, which is, so Apple's earning 28.3% return on assets. Now, is that a lot? It sounds like a lot. I mean, one way when you benchmark some of this stuff, think about what like the average return in the stock market is. If you invest in like a diversified stock portfolio, what are you earning every year? I don't know, 8 or 9%. I don't know. I mean, with inflation going crazy, who knows? But usually, typically, historically, 8 or 9% in the stock market, right? So one thing you can compare some of these return percentages to is like, well, what's the average stock market return? So when you see a company generating 28% return on assets, you're like, wow. So they're earning 3 times the stock market return on average, which shouldn't be surprising because Apple's a very successful, like we all know, Apple's been a very successful company. So, but so that's just an example of ROA, and we're going to get a little more complex now, okay? And we're going to calculate by hand. You can follow along with me. Oh, by the way, Paolo posted, there should be a link to a Google Drive folder where this PowerPoint is there. I just got a message that my internet connection is unstable. Hopefully I'm still coming through. That's weird. I have gigabit internet that usually is very, very strong, but okay. So DuPont analysis. DuPont analysis, it's not from some famous, economist or research scholar that named something DuPont. It's actually from the DuPont corporation that makes like, Teflon coating for pans and, plastic products and stuff. It's from the DuPont company. It was generated by their accounting and finance division, I think in like the 1920s, as a way to break down financial ratios into different components so that you can learn a little bit more about the different dimensions of the company. And so what DuPont analysis does is it's going to split that ROA ratio into 2 different ratios. So this is the ROA ratio that we just saw, right? Net income over assets. And it turns out through the power of 7th grade math, actually, yeah, should be 7th grade, 6th grade math, maybe, whatever. You can break it down into 2 ratios: net income divided by sales multiplied by sales divided by assets. And notice, right, through the power of math, so that's profit margin and asset turnover. But notice through the power of math that the sales cancels each other out, right? And so these 2 ratios could easily collapse into the ratio on the left. So that's the idea here, is that mathematically these 2 things are equivalent, but we want them to be 2 ratios. We want the 2 ratios is going to be useful, okay? And it should be a little bit of a clue why this is useful based on the names of this. So net income divided by sales, that tells us the profit margin of the company. And then sales divided by assets, we call that asset turnover. But what it's literally measuring, if you want to figure out what a financial ratio is measuring, just look at what's in the ratio. What is it? Sales divided by assets, okay? Now, oh, by the way, sales and revenue are the same thing. So I use these terms interchangeably. And at the top of some companies' income statements, you'll see sales, some you'll see revenue, sometimes you'll see sales revenue, right? So it's just like interchangeable terms for the same thing. So sales divided by assets, what's it telling you? The dollars of sales per dollar of assets. So even though this thing is called asset turnover, what it's really telling us is how much sales can you generate? How much sales does the company do for every dollar of assets that it has? And so, in words, profit margin is the amount of profit the company earns from each dollar of sales. And then asset turnover, it's a productivity measure telling us how productive assets are. What's the volume of sales for each dollar of assets? Okay. And one kind of side note here is that profit margin, people get confused sometimes, and it's easy. I get confused too. And you have to be careful what terminology you're using. A lot of people talk about profit margin, or they may call it gross profit margin. And they're talking about like kind of the top of the income statement, where it's like sales minus cost of goods sold equals gross profit. But this is not the same thing, right? This is net income. So we're talking about sales at the very top of the income statement, and you got minus all these expenses, right? And then at the very bottom, you've got net income. So this is the total profit margin percentage on the firm's sales after you've deducted everything on the income statement. Okay, all the expenses. All right, so let's calculate this. It's not too difficult, but let's do a little DuPont analysis for these two companies. And this is timely because GameStop has experienced a lot of excitement from certain investment groups in the last few years. And it's also, GameStop's been struggling a little bit, although it has been improving. I was very surprised. I was looking at the trajectory of the financial statements over the last few years, and surprisingly, they have been, I guess, doing what they can. So let's figure out what the ROA is, but we're going to do so by calculating profit margin and asset turnover. Okay. So, and obviously, right, one part of doing these ratios is finding the right numbers, right? Opening the company's annual report or opening the company's financial statements and finding the right numbers in there. And that's not always easy. I mean, you should be able to find net income, right? You should be able to find sales or revenue, and you should be able to find total assets. But as we'll look at later, some of the numbers in the financial statements it's not so cut and dry, like, okay, what number should I put in here? All right, so let's compare these two companies because it's a pretty stark difference. So for GameStop, GME, right? That's just their stock ticker. So for GME, I'm going to first calculate the profit margin, and the profit margin is net income divided by sales. And so, and this is all in billions. Just right. The other thing you want to make sure is that your numbers are in the same kind of denomination. Sometimes that doesn't happen, right? The income statement numbers are much smaller than the balance sheet numbers. So you accidentally try to divide 1 million by 1 billion or something. But okay, so the net income, unfortunately, it's actually a net loss for GameStop last year, is, so negative 0.31 billion, or I guess that's negative 310 million, divided by the total assets of 3.1, right? And then with DuPont analysis, and in a little bit, we're going to see a DuPont ratio with 3 ratios. But in DuPont analysis, you always know that I'm sorry, I just copied the wrong thing in there. Well, if I can bring up my eraser here, there we go. I'll get this eventually, guys. All right. It's, sorry, over 5.9. Sorry, net income over sales. And that's the other mistake that you easily make, or I easily make with financial ratios. And when I give students exams, I always feel bad because usually when a student misses a financial ratio problem on an exam, it's because they just did what I just did. And it's like they know the answer, but it's like, it's pretty easy to just like, oh, copy it down the wrong number. But the next ratio always has to have the same, like if it was in the denominator of the previous ratio, it's got to be in the numerator of the next ratio, because we know they have to cancel out and collapse into ROA. So sales over total assets, 5.9 over 3.1. Okay. And if you do the math, there's some rounding here, but it's about negative 0.05 for the profit margin. So that's negative 5% profit margin. And then that gets multiplied by, right, because the profit margin is how many dollars of income per dollar of sales. And then we're going to multiply that by how much sales they're generating per dollar of assets. And so that asset turnover is 1.9. So what this is saying here is that for every dollar of assets GameStop has, they're generating $1.9 of sales. And each of those $1.9 of sales they're generating has a negative profit margin attached to it, okay, of negative 5%. Now, if you multiply these two things together, you get approximately negative 0.1, or every decimal is equivalent to, you could express all of these if you wanted to as percentages. So, and that's a negative 10%. So GameStop's return on assets is negative 10%. It's losing 10% of its assets each year. It actually used to be losing more than that. So even though this looks not that great, they're actually doing better than they were a year or two ago. So let's look at Best Buy. I mean, we're going to do the same thing with Best Buy. So does anybody have questions about this? Profit margin, asset turnover. Again, I think that the real key thing to understand is for every dollar of assets, they're generating $1.9 of sales. And then that $1.9 of sales is getting them a negative 5% return for each dollar. And so when you put those two things together, it's a negative 10% return on assets overall. Questions about that? All right. So again, feel free to jump in anytime. And so for Best Buy, BBY, we've got net income. Let's see if I can do it right this time. We've got net income 1.4 billion over sales of 46.3. We already know this is going to be better because at least it's positive, right? And then our asset turnover is 46.3 divided by 15.8. And so that, if you do the math, is approximately 0.03 multiplied by 2.93. Now, we already see both of these are a lot better, right, than GameStop. Best Buy, for every dollar of Best Buy's assets, they're generating 2.93. They're generating like a whole extra dollar, right, for every dollar of assets than GameStop is. And then luckily for them, they have a positive profit margin of 3% on each dollar of sales. So when you multiply these two things together, Best Buy has approximately 0.089 or 8.9% return on assets. Okay. So the spread on these two companies is pretty crazy, right? You've got like a 19% spread on return on assets being generated. And you can see for Best Buy, it's coming through, because that's what I was talking about right in the beginning of this, of these slides, is we're not just interested in how profitable a company is. We want to know what some of the drivers are. And so you'll see companies where and this is actually pretty common, and we'll talk about this in a second. You'll see companies where they have a really high profit margin, but they have a really low asset turnover. And then you'll see another company in a different industry that has a really low profit margin, but a really high asset turnover. But then when you multiply those two things out, it's like a wash. They're both earning 5% return on assets or something, just in very different ways. But in this case, we've got two retailers, right? Best Buy and GameStop. They're both brick and mortar retailers that also have an online presence. And you see Best Buy's doing better on both dimensions, right? Profit margin and asset turnover. Does anybody have questions about this? Okay. I know it's early in the morning. I didn't sleep well last night. It was really hard for me to get my energy together this morning. I was like, am I going to be able to go in here and do this? But it's good. I got my coffee, so it's turning out okay. But I know you guys might not be very energetic on a Saturday morning. So far, so good. Okay, Nitin, thank you. I'm glad. I always wanted, I assume it's pretty easy to understand. This is certainly easier than the valuation stuff. Okay, so this is a stolen, obviously, thanks, Ron. This is a stolen chart, as I like to do and not give credit. If I was submitting my stuff as a student, I'd get my plagiarism, my grade dinged for plagiarism all the time, but free use in an educational context, that's what I've heard. So wherever this came from, and I don't know if you guys remember, and we probably have a mix of students here. I'm guessing that some of you guys are like, yeah, we're going to talk about Banesh. We're going to talk about Banesh in a little bit. Oh, is that a news story? Is that a news story, Ron? Or is it?
That's not news story, but you mentioned last time, and I really appreciate what you put there. And I'm trying to see if there's some correlation between the Dupont and,
So we're going to talk about the M-score. So I don't remember who. The M-score was prompted by someone's question in the last session.
Yeah.
I wasn't going to talk about it at all. I am going to talk about it at the end of today's session because the M-score uses financial ratios. Okay, like that's the underlying logic.
Yeah, exactly. But if you click on this link, it's perfect. You can find anything over there. You just do the calculation for you.
Oh, really? Okay. Well, I'm gonna share spreadsheets with people too, but and talk about it. But that's a great link. Thank you. I'll copy that down. I'm afraid to click on anything while I'm in my Zoom lecture mode. I'm afraid it's going to like crash or close a window. But thanks. So I don't know if you guys remember, or if you're a first year, maybe you're taking this right now, or I don't know what point you guys are, but your economics classes, right? So like, and some of you guys have undergrad business degrees like I do, I assume. Oh, I didn't introduce myself. My name's Nick Seibert. So I've been a professor here for like 13 years. But I do have my undergraduate degree from Maryland as well. So when I was getting my undergraduate degree and taking economics classes, we spent like 80% of the time in these classes. That's if you're lucky, looking at charts like this, where you've got two axes and then you've got curves, right? And you spend all this time shifting curves around. That's at least what I did in my economics classes. If you're unlucky in economics classes, you just do a whole bunch of math and you never see a chart. So, but this should be, you've seen at least one economics chart before, and that's what's happening here. We've got down here on the x-axis asset turnover. So that's one of the ratios we just talked about. And on the y-axis, we've got profit margin. And that's the other ratio we just talked about. So we just learned that if you multiply profit margin by asset turnover, you get return on assets, right? And so what these curves are, these curves represent the overall level of return on assets, okay? And so and obviously what we have here is a bunch of different industries that are plotted with the dots, okay? So if you multiply these asset turnover and profit margin together, you're going to end up somewhere on this chart. And if you're on the blue curve, you've got 6% ROA. If you're on the black curve, you have 3%. And obviously, if you're in between, you're in between, okay, is the idea. And oh, pharma is pharmaceuticals not on here. First of all, this is an old chart. I think I stole this like 10 years ago, but I haven't found a clearer one yet. Yeah, not every industry is on here. There's just tons of industries.
Look, there's fishies. Look.
Okay, I'm getting better at muting people. I'll try. I always try to mute people soon, but okay. So let's pick out just a couple industries here though to talk about. All right. So, and I would like to pick ones that are kind of relatively close in overall ROA, just for illustration purposes. Let's look way down over here at grocery stores. So what's going on with grocery stores? They have the highest asset turnover, or in other words, dollars of sales per dollar of assets of any of the industries here, right? They have the highest turnover. They also have one of the lowest profit margins, not quite the lowest. Wholesaler is a little lower, but so grocery stores have a really high asset turnover, really low profit margin. Does that make logical sense? I mean, the other reason I picked this industry is because we all kind of know about grocery stores, right? You guys eat food. I eat food. So we go to grocery stores. What is the nature of that business, of grocery stores? Does it make sense? Do we expect grocery stores to have a high profit margin or low profit margin? Ron, the only person I can see is Ron. He's saying thumbs down. So I'm assuming that means a low profit margin. What do grocery stores sell, right? If you guys think about I don't know where you would learn this, but Porter's 5 forces, and then the idea of differentiation and cost leadership, right? How differentiated is a banana, right? Or a frozen meal or something, right? It's not, grocery stores aren't differentiated. You can go to Safeway, Giant, Whole Foods. It's all pretty much the same. And so how are you going to command a profit margin, right? Consumers can just switch to the store down the street if your eggs or your bananas or whatever are too expensive. So the profit margin's got to be low. The other thing is, what item is the grocery store selling? The grocery store is selling food, right? Can food sit on the shelf for a really long time? I mean, some of it can, but in general, there's a lot of spoilage, right? Especially among the more expensive items, the milk and the eggs and stuff like that, meat. And so they've got to sell it. And so when grocery stores have to sell stuff, what do? Very common to see at the grocery store, right? I know when I go to buy some beef or something, there's always going to be something that's like super blowout sale. And you look at it and you're like, oh, it expired yesterday, right? That's kind of how it works. So the profit margin's low and turnover has to be high for the same reason. They're selling food that goes bad, okay? And they're not selling Ferraris, right? Where you can just sell one every 6 months and be good. They're selling bananas and stuff. So you've got to turn over a bunch of product really quickly. So that's the nature of that industry. And we can see it in the financial ratios. very high turnover, very low profit margin. Let's look over here at hotels. I mean, there are some other industries that are even more like this, like utilities, but I feel like we know a little bit more about hotels. We've all stayed in one, I would assume. So hotels is about, look, they're both grocery stores and hotels are very close to the black curve. So these totally very different industries on average, from whatever years this graph was stolen from, were earning about the same overall return on assets. But hotels has super low asset turnover and a much 3 times the profit margin. Now, why is that? Does that make sense for hotels? Well, what are the assets or what's the nature of the business that a hotel is operating? Now, we might have some people here who work for Marriott, which works a little bit differently. But let's just think about the actual owners of the hotels themselves. Because if you don't know, Marriott basically just franchises their name out and they don't actually own a lot of those properties. But I think the hotels, when they're looking at that industry, they're looking at the actual property owners. So what do they have? They have these massively expensive assets, right? They have these like $50 million buildings built in prime city center areas. So they have a massive amount of assets, which makes it hard to have high asset turnover, right? I mean, you're generating as many sales as you can, but your assets are just so costly. And so as a result, that's why they have to mark up the price of the hotel rooms, right? And so that's why they have to generate a high profit margin on the hotel room itself. Like you go in there and you're like, they're not even cleaning my room, right? These days, they found all kinds of ways to squeeze out the extra profit margin. It's like, make the green choice, right? Don't make us come in and clean your towels and launder your sheets and fix stuff up so they can employ like half the cleaning service, half the laundry costs. But overall, the main cost of the hotel is just the building, which is just sitting there, right? So, right, management fees, occupancy rates, that's also true. That's also true. I think it's maybe getting harder for hotels. Although my wife just told me she has a friend that works at Marriott. I don't know if her friend is very knowledgeable, but her friend said that Marriott properties in the recent months have been 90% occupied, which surprised me. They're doing wonderfully. Apparently, Marriott's doing wonderfully. I don't know if I'm supposed to share that inside information, but presumably somebody's already acted on that, and the stock market has already adjusted for it. Okay, so those two DuPont ratios tell us very different stuff about the companies, and we see that it can be very different in different industries. So as a side point, which maybe should be obvious, when you are doing financial ratios and you're trying to figure out which company is doing better than another company, typically you would want to pick companies from the same industry, right? That's why I picked Best Buy versus GameStop, right? I didn't pick Best Buy versus Marriott or whatever, right? We want to analyze companies that are as similar as possible to each other. All right, so then the next ratio is return on equity. And this is the one, again, that I think this is the most important one because I view myself as a stock investor and a shareholder. I'm not going out and like acquiring entire companies. So therefore it's of more interest to me what the company earns on shareholders' investment. But it's up to you what you want to emphasize. Every analysis has a different focus. So it's a very simple adjustment. Instead of having assets in the denominator, we have equity. Okay. So ROE, return on equity, equals net income divided by equity. And that's the total shareholders' equity on the balance sheet. We also have we'll just jump right into the DuPont analysis of this. Now we're going to break it into 3 components. And this is the more common DuPont analysis, the ROE one, where you break it into 3 components. So what we see here is the 2 ratios we just had. So the first 2 things, there's nothing new. That's just profit margin and asset turnover that we've already been dealing with. But then we've got this third one. What is that? It's leverage. All right. And again, I know we have a diversity of people in different years and have had different classes, and some of you guys might have had finance or whatever, like a long time ago. But all leverage really means is to what extent the company is using debt versus equity in its capital structure. Right? Like if they're gonna take financing, are they gonna take debt financing or equity financing? Now you might say, but look, that's not debt over equity that I see there. That's assets over equity. We'll get to that in a minute. Okay. Trust me for now, it does measure the extent to which you use debt. So again, this is in words. We've already seen the first two. Leverage is the new one. It's the degree to which the company finances with debt rather than equity. Okay. And notice, very important, that we saw the first two ratios before because those first two ratios are ROA, return on assets. So return on equity is very closely related to return on assets. It is precisely equal to return on assets multiplied by leverage. Again, this weird leverage ratio, assets over equity. Let me prove to you real quick. So remember, assets equals liabilities plus equity, right? So the leverage ratio that we saw from DuPont, which is this guy, assets over equity, right? I'm doing some more like 7th grade math here. Assets over equity equals, yeah, PE firms use leverage tremendously. Yes, I know that. My wife's company just got bought out by a PE firm, and we're like terrified because they leverage the shit out of it. And now interest rates are going up, and we're like, maybe you should start looking for other jobs. Okay, so assets over equity, right? It must be equal to liabilities over equity plus equity over equity, right? Because assets equals liabilities plus equity. So all we've done is I just divided all these things by equity, right? So that's got to be true. Or if you want to simplify this a little bit, assets over equity is equal to liabilities over equity plus 1, right? Because equity over equity, that just cancels out and becomes 1. So in that leverage ratio in the ROE DuPont analysis, even though you don't see debt or liabilities in there, they're related on a one-to-one basis. Like if one goes up, the other's going up. It's just that there's this kind of like fudge factor here of a +1, okay, that you would have to add. So essentially, if you have an assets to equity ratio, you could get to liabilities over equity just by subtracting 1. All right. Now, so then why don't we have liabilities over equity? Why don't we have liabilities over equity here, which would be a more common leverage ratio? Well, because if we had liabilities there, then the ratios wouldn't cancel out, right, and collapse. We need to be able to cancel those guys out and collapse into ROE. So it's kind of a roundabout way to measure leverage, but still be able to have these 3 ratios that represent return on equity. Okay. All right. So the other thing to think about is given this fact, right? Given that ROE equals ROA multiplied by leverage, what that means is if your intrinsic return on assets is like 10% and your leverage ratio is 1, then your ROE is equal, right? If leverage is 1, then your ROE is going to be equal to your ROA. If leverage is 2, you just doubled your ROE relative to your ROA, right? So whatever return on assets a company is generating, leverage severely can magnify that. And so that might make it sound like, oh, wow, debt is amazing, right? Like, oh my God, let's just get like 800% debt, right? And then we'll have an amazing return. And of course, the riskiness is that, look at what we just saw with GameStop. What if you have a bad year, right? What if you have a negative ROA? Well, if you have a negative ROA, then a leverage ratio is higher leverage is also going to magnify that and make it more negative. Okay. So this goes back to just like the general idea that debt is risky. And this is one example of why, because it magnifies any like inherent return the company's earning. And yeah, you can have really, really good years. You can also have really, really terrible bad years. And that's without even touching on the idea of like bankruptcy and stuff like that, which is, we'll talk about a little bit more later. Okay. So let's again use the same companies, but this time let's do ROE. We already calculated ROA, so we know like the first 2 ratios, profit margin and asset turnover, we already calculated. So I'm not going to redo that. I've just copy pasted the ROAs from the previous calculation. Okay, so for GME, we're going to start with the negative 10% return on assets, and then we multiply by the leverage ratio. And again, this weird leverage ratio is assets over equity. So which in the case of GME is 3.1 over 1.3. And if you do the math, that's, well, we don't need to do the math on the negative 10%, but it's negative 10% multiplied by 2.38. So what that 2.38 is saying is that for every dollar of equity, GameStop has $2.38 of assets. Okay. So clearly its assets aren't all financed by equity, right? If they were, then it would be one. But so they've got an extra $1.38 of assets financed by liabilities. Okay. So if you do the math on that, negative 23.8%. So we see right here in this, it's actually kind of hard to find. I mean, not that many companies lose money. I mean, we're probably going to see more as the economy maybe slows down here. But for the last like 10 years, with all the easy, cheap debt and everything, and the economy's just been doing really well, it's actually kind of hard to find companies that most people think about, because we usually think in our minds about very successful companies like Apple, right, and Google, and they don't usually lose money. But we see right here an example of that leverage riskiness where, gosh, GameStop probably really wishes they had less debt, right, or like less liabilities, because that negative 10% that already sounded bad is to shareholders is almost a negative quarter, right, a negative 23.8% of their investment. So that doesn't sound great. Let's look at Best Buy. Best Buy had an ROA of 8.9%. That's good because we know any leverage is going to make it even better. And their assets to equity were 15.8 divided by 2.8, which we can already see is a much higher leverage. Not necessarily a good thing, but as we'll talk about later. But this year, it's pretty good. 5.64. That's pretty high. I mean, I've calculated a lot of leverage ratios. That surprised me for Best Buy, that for every dollar of equity, they have $5.64 of assets. So Best Buy has a ton of liabilities. But what that ends up doing, this is crazy to me, because I don't usually think of Best Buy as a very successful company these days, but I mean, last year they generated a 50% return on shareholders' investment, which again, think about the stock market, right? 8 to 9% a year. Best Buy earned 50% on shareholders' investment. So what we saw before, where GameStop, there was a spread of like 19%, right? GameStop had negative 10%, Best Buy had about 9%. That's turned into, thanks to leverage, like a 74% spread, right, between these two companies, which to me is just insane. But anyway, that's the power of leverage in magnifying returns. We're actually going to get even more deep into this, I know, because you love it so much, but we're going to do a much more complex version of DuPont analysis in a minute. So if anybody has any misunderstandings or concerns or questions right now, would be a good time to try to kind of clarify those or ask those questions. Okay. We will take a break after the next analysis. We'll take a break, but the next analysis is probably going to take about 20 minutes, I'm guessing. I'm just ballparking that. Okay. So seems like there are no questions. And we'll look at just a couple charts. So this is for Apple, all these different things graphed, the different DuPont ratios, and then the overall ROE. And I don't know when I'm going to be able to actually go back. I have an Excel file, but I just never end up fixing the rounding here. But for whatever reason, this is actually, I think, 0.25, and this is 0.30. So Apple's profit margin has kind of ranged between 25% and 30%. 2.5%. And yeah, no, it is. Oh shit, it is 25%. That just sounded so insane to me. I was like, no, it must be 2, but Apple's not a grocery store. It is 25%. Apple has 25% profit margin. And then, last year it went up to 30%. We could go look at why, right? That's the kind of thing that these analyses lead you to, like, gosh, what was their product mix? Did they raise prices on iPhones? Like, did they sell more expensive MacBooks? Why did their profit margin go up? But they've been still pretty tight, 25 to 30% over the last few years. But look at their leverage. Look at their leverage for Apple. Their leverage has like doubled in the last 5 years. And that is literally Apple repurchasing stock, paying out dividends. So they've been shrinking their equity, and they were taking on more debt. Okay. And so Apple's leverage ratio is just really ballooned up. Also, and this is nice, they've gotten a lot more efficient with their assets too, right? They've gone from generating 60 cents on the dollar to over $1 on the dollar, right? How the hell do they do that? Well, part of it is Apple hoards cash, if you didn't know that. AAA rating definitely helps. That is correct. That's correct. I like the comments. Yeah. No, it helps to have cheap debt. And one, you guys should know from finance class, like if you can get cheap debt, that's wonderful, right? Unless your company's just super facing cash flow challenges in the future. But if your company was facing cash flow challenges in the future, they probably wouldn't have cheap debt. Okay, so it kind of goes hand in hand. But as a result, look what Apple's return on equity is like, almost like exponentially increasing over the last few years, just because both their asset efficiency and that extra leverage they're taking on. So Apple had a 150% return on equity in 2021, which is just wild. Okay. All right. And then finally, we looked at the plot across some different industries of, profit margin versus asset turnover. And here's what, Ron was talking about, pharmaceuticals. We see them here. Again, well, how do they select what industries to plot? I don't know. But again, I steal all these things. So we see the leverage ratio, and this is actually liabilities to equity, but again, very similar to assets over equity. And you can see that varies strongly by industry, right? So food, a lot of grocery stores and stuff like that, and food manufacturers, they have very high leverage. Pharmaceuticals have very low leverage, right? And I don't want to like belabor the point too much, so I won't make someone answer. It seems like people don't want to like answer questions too much, but anyway, why do we, and there are lots of reasons why we might observe these differences, but the reason for the differences across these industries is the predictability and the riskiness of cash flows. Okay, because, and we'll get more into this when we talk about the credit analysis part of this class, but we kind of can't avoid it here because even in profitability analysis, debt and leverage comes into our calculations. So pharmaceuticals, right? What's the nature of that industry? It's like R&D, 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 R&D. Whoops, the drug failed, right? I mean, they spend all this money developing these drugs, and then a bunch of their money is made by like random hits, essentially, of like, oh my God, like, you developed the COVID vaccine first, right? Or like, oh, you're the only one with a heart attack drug or something like that, right? And so when they get these knockout drugs, they have, the earnings are just flowing in, but then they might have many years, especially in the early years, where they just don't have any cash flow at all. Yeah, very long-term investments. That's right. Very long-term investments. These projects can take like 20 years to develop a drug. Food, we just talked about it, right? It's like, buy the eggs, buy the bananas, right? I mean, if you almost just know how many people there are in the city or the state or the country that you're selling in, you can almost just like perfectly forecast how much food you're going to sell. I mean, that's not exactly true, right? But much more so than software, okay, or pharmaceuticals. And so that's very predictable cash flows in that industry. And so they can have a lot of debt because they know they're going to be able to make their interest payments. They know they're going to be able to repay the principal because it's much easier to plan long term. Okay, so just another example of how ratios vary across industries. All right, now we're going to get into finance and accounting uses very different terms and intuition for what we're about to talk about. I'm not even sure that if in finance they even call this advanced Dupont analysis, but in accounting we do. And just as a little bit of a spoiler alert, we're going to be talking about return on invested capital. And in accounting, we usually don't even call it return on invested capital. But I personally find the accounting way that we do it so convoluted that I use mostly the finance terminology mixed with my own. Okay, but we do call this advanced Dupont analysis because we're still going to decompose returns into different components. okay? But we're going to do so in a much more complex way. All right, and many people would say this is a more useful way to do it as well. And it's going to show us a few things that we couldn't tell from the ROE ratios we calculated a minute ago. We're gonna get some more insight into the company. All right, so again, this is like the third time this guy's come up, right? Is that when you have leverage, leverage magnifies whatever return you're earning on your assets, and that goes out. That magnification is what's goes out to equity holders in terms of ROE. Okay. Advanced Dupont analysis, and we'll talk about what the adjustments are in a second. We're basically making a couple of adjustments. That makes it sound way easier than it is, because the adjustments, there's several calculations involved. But we're basically making two adjustments to ROA, to return on assets. And by making these adjustments, instead of the thing you see up here, we're going, instead of a multiplication effect, we're going to have a plus. And you might at this point be like, well, who the hell cares? But we're going to see that I think it tells us something different and maybe more useful about the company. So we basically want to find a way to, instead of just being like, well, your ROA is 10% and maybe your leverage is 2, so we do a multiplication and surprise, surprise, ROE is double. This advanced Dupont analysis is going to tell us the precise percentages of returns that are attributable to each of these different components. So to do so, though, we need to talk about what is return on invested capital. It's similar to return on assets, but it's not. And then we're going to add this magnification effect of leverage to that, okay? All right, so what's return on invested capital? And again, unfortunately, different people have different terminology for some of this stuff. This is just what I've chosen. This is the way I think about it. So return on invested capital, not surprisingly, right? The denominator is invested capital, right? Just like when ROA, the denominator is assets. ROE, the denominator is equity. So we'll talk about what invested capital is. And then the numerator is not net income. It's net operating income, okay? Some people would call this earnings before interest, but you've got to be careful because I'll talk about some caveats in a minute about what this actually is. So the first step is to figure out the core return on a company's financed assets, regardless of how they're financed. So we don't care where the financing is coming from. We want to look at their return on all the financing. And the financing, there's two sources, right? There's debt and there's equity. And so we're going to combine debt and equity together. That's the idea here. Their return on all debt and all equity. That's the return on invested capital. Since we're measuring the return on all the capital, we need to make an adjustment to net income. And this is an accounting peculiarity of just how accounting is done in the United States. Well, I guess in most countries in the world. And you may not remember this from accounting, but interest expense, right? Interest expense is on the income statement. So when you're looking at net income, interest expense has already been deducted. But interest expense is the primary return to debt holders, right? It's the return to the bank on the loan they gave you. It's the return on the bond to the guy who bought the bond, okay? And so if we want to figure out the return to everybody, we have to add back interest expense, right? Because we're already subtracting out their return. It doesn't make any sense. So we're going to add back interest expense net of taxes, and that's how we get net operating income. Okay, so we'll do this in a little bit. And then finally, invested capital, the denominator, is just the sum of all equity and all debt. Okay, now the other, what I find to be really convoluted way of doing it is some people will do it the opposite way. They'll take total assets and then they'll subtract all the non-debt liabilities, like accounts payable, taxes payable, wages payable, rent payable. They'll subtract all that stuff from total assets. And because of the way accounting works, that assets equals liabilities plus equity, those two things will give you the same result. But I don't know why anybody does it that way. I mean, it seems much easier to me to just add the debt and the equity, right? Anyway, but just to let you know, some people do it the opposite way. Some textbooks even teach it the opposite way. I don't know why. Okay. So I want to walk through, because we are going to do a very involved calculation here in a minute. But I just never liked that. Like it has so many moving parts that I hope to do a little bit more of an intuitive explanation about, like, what the hell are we doing here? Okay. And so I hope this will help. If it doesn't help you, then I guess you can just ignore it. But okay, so this is probably about the simplest example I can think of. All right. So this company has and we're going to assume no taxes here. So that makes it extra easy, because we are going to have to take taxes into account at the end of things. So we've got this company. It just started business. It's got the very creative name of XYZ Corp. And shareholders invest $1,000. Okay. So here's the financial statements here. So the shareholders invest $1,000. You can see it there in equity. The company immediately turns around and uses that money to purchase assets, whatever that is, right? Buildings, trucks, inventory, whatever. So they use that money to purchase assets. There are no liabilities, okay? So let's just assume the company is paying their employees in cash immediately as they work. But the important thing is the company has no debt. There's no debt. The company is financed entirely by shareholders or an owner or whatever you want to call it. Because of the nature of this company's business and the way that it operates, it earns 20% on its assets, okay? It earns 20% on its assets. How do we know that? $200 divided by 1,000. Now, in this case, right? In this case, ROA is equal to ROE because the company has no debt, okay? ROA is equal to ROE, right? Because look, just do it in your head. What, net income divided by assets, net income divided by equity. They're both 1,000, right? So it's got to be the same. So in the case when a company, of course, you'll never see this really in the real world, but that's why it's a simple example. So if you have a real company with no debt and no liabilities, ROA exactly equals ROE. Okay, so this is the simple example, and then we're going to go step by step and make it more complicated. Anybody have questions about this? Okay, all right. So now we're in year 2. And we're going to assume the same thing about the company, that intrinsically, because of its line of business and its operations and stuff, it can earn 20% return on its assets. Okay, but now it's going to get debt financing. It's going to get a bank loan or whatever. Okay, it's going to get debt. It's going to take $500 in debt, and then it immediately turns around and buys the same mix of assets that it had before, right? It just grows the company. But in year 2, we're growing the company with debt rather than equity. All right. So the company now is making 20% return on assets, but how many assets does it have? 1,500, right? And so the 20% return on assets now is going to generate $300 in net income, right? If you have 1,500 in assets, 20% return on that is $300 in net income. And so it would be tempting to think, hey, so we have a $300 ROE, we have a 30% ROE, right? 300 divided by 1,000, but we don't. Why? We're subtracting $25. What's the $25? Why am I subtracting $25? The $25 is the interest payment on the loan. Right. We were just talking about, like, on the income statement, we have to subtract interest expense, right? And so the net income, the ultimate net income that the company is going to report is $275. So I made the note here. So the company used debt to generate $100 more in net income, but it also has to pay out $25 in interest. Okay. But look what's happened, though. Look what's happened. We went from an ROA of 20% and an ROE of 20%, right? To now, that 20% ROA has turned into 27.5% ROE. Okay, so there's an extra 7.5% return on equity being generated here as a result of using debt, okay? And the intuitive reason is each dollar of debt that they have, right, that they use to purchase assets is generating a 20% return. and they've only got to pay 5% out to the debt holders. So they're pocketing the difference there. Okay, now it's a little more complicated than that. We'll get to that in a second. But so this is the logic of how debt or leverage affects a return. Okay, so what we're trying to really figure out at the end of the day is what is the precise percentage effect of leverage? Now, if you just look at the math we just had, the simple math, right? When the company had no debt, return on equity was 20%. When the company has debt now, the return is 27.5%. So now you can eyeball that and say, well, there's a 7.5% effect here, okay? But how did we get that 7.5%, right? Because it's 5% interest, 20% ROA. How the hell did we get down to 7.5% effect here, okay? So we can calculate that. There are several steps. And the key is we hadn't considered yet in the prior example the leverage, like what percentage of debt to equity do we have? Because that's the missing piece here that matters. So we need to calculate the overall percentage effective leverage, which we think is going to be 7.5%. It should be. So we need three things. First, we need the net borrowing cost, the percent interest paid to the debt holders. In this simple example, I gave us that. It was 5%. Okay, but when you have a real company's financial statements, you have to calculate it. And they're not going to say we paid 5% on our debt. Not usually. Okay, so you got to figure out what percentage interest they're paying. And that's after tax. That's after tax borrowing costs, by the way. And we're assuming in this simple example, no tax. Then you calculate the spread. And that's the difference between the return on invested capital and the net borrowing cost. So in our simple example here, the return on invested capital was 20%. And the net borrowing cost is 5%, okay? And then finally, you need the leverage, the leverage ratio. And in this case, it's the actual just debt to equity. How much debt versus how much equity are you using? And so then the leverage effect is equal to leverage times spread, or equivalently, leverage times ROIC minus net borrowing cost, right? Because the spread is just the difference between ROIC and net borrowing cost. So first we're going to calculate return on invested capital. Then we're going to calculate the net borrowing cost. Then we're going to get the spread. Then we're going to multiply the spread by the leverage ratio. Okay, so you can see there's a lot of little calculations here, all right? And we will get to those in a minute. But so in this simple example, what would that calculation be? In this simple example, we had $1,000 of assets financed with equity, right? Then remember, the second year they took out $500 in debt. So $500 asset financed in debt. So our leverage is debt divided by equity, or 500 over 1,000, 0.5. So our leverage ratio debt to equity is 50%. Excuse me. We know our return on invested capital is 20% because I told us that, okay? That every asset bought with every type of capital generates 20%, right? That was just our assumption. We know the net borrowing cost 5% because I told us that, right? So a lot of the stuff I told us in the real world, we're going to see, we'll do it with Apple. We have to calculate some of this stuff. But then the leverage effect is that. It's leverage ratio of 0.5 multiplied by the spread. And the spread is the return on capital minus the net borrowing cost, okay? And so, oh, wow, look what it is, 7.5%. So that calculation is how we got to, so basically, XYZ Corp, remember, it went from 200 profit to 275. So the ROE went from 20% to 27.5%. The reason for it intuitively is they borrowed $500 at 5% interest, but that $500 was earning them 20%. But why is it not then a 15% difference? The reason it's not a 15% difference is they're only half financed by debt as much as equity. That's where the leverage ratio comes in. So the difference of 7.5% is that 15% spread multiplied by the relative weight of debt to equity. And so what that gets us, now we're back to where I had the first slide on this of what we ultimately wanted to compare. ROE equals ROIC plus the leverage effect. In this simple example, it's this. ROE is 27.5%, which represents the 20% core return on invested capital plus a 7.5% bonus that's coming from the use of debt, that leverage effect. Okay. So this is the simple example. And now we're going to get a little bit more complicated here. Okay. So this is using real numbers. All right. You know what? Let's go ahead and take a 15-minute break. This is pretty involved. Yeah. No, Ron, you don't want to take a break?
It's getting, yeah, let's take a break.
It's just, this one has a lot of calculations. And I also want to pull up financial statements to show you guys something about some of these numbers. So why don't we take a 15-minute break, meet back here at 10 o'clock. And I'll show you guys some financial statements, then we'll jump into this calculation. Okay. All right, great. Okay. So unfortunately, for those that were here and paying attention, I forgot to hit record when we came back from break, and how lucky I didn't record kind of the single most difficult analysis in the entire session. So I am redoing that here, plus part of the next slide of another analysis. So I'm going to try to bridge the gap and splice this video into to the other two videos as seamlessly as I can. But it's very important to get the most difficult analysis should clearly be recorded. And that is this Advanced Dupont analysis. We'll calculate the more complex version of the simple example we just saw. And in the simple example, I had provided us with the borrowing cost, the percentage interest rate that the company paid. We ignored taxes. I gave us the return on invested capital, which in that example was equivalent to return on assets because it was a super simple example. So I told us it was 20%. Okay, but in the real world, you don't know that. In the real world, you've got to calculate that stuff yourself. And there are a bunch of moving pieces there. And so that's why we really need to focus on this exercise. So this is Apple in 2021. And we want to figure out, okay, again, what we're trying to figure out in Advanced Dupont Analysis is the relationship between return on equity and then return on invested capital plus the leverage effect. Okay, that's what we're trying to do here. And so it says calculate ROIC and the leverage effect and reconcile to ROE for Apple. So let's do it. All right, so you can do this in any order you want to. I always tend to do it in the same order, and I start with ROIC. And ROIC, the return on invested capital, is equal to net operating income divided by invested capital. So the first thing we need to figure out is net operating income. Net operating income, as I mentioned before, it's just net income with interest expense net of taxes added back to it. Because we're trying to figure out the return on all the capital invested, regardless of whether it's equity or debt. Net income has already had interest expense deducted. That's just how the income statement works. Interest expense is a line item that's deducted. Interest expense also is tax deductible. There's a tax shield of interest, if you recall from finance class. So when we add back the interest, we need to add it back multiplied by 1 minus the tax rate, because you have to pay taxes on every additional dollar of income. Okay, so to get net operating income, we start with net income of 94.7. We add back the 2.65 billion of interest expense multiplied by 1 minus the tax rate. Okay, and for Apple, I calculated tax expense divided by pre-tax income. Apple's tax rate is 13%, substantially lower than your or my tax rate, I would assume. So if we do that, we add back interest net of taxes. I might have some rounding in here, but it comes out to a fairly even $97 billion in net operating income. And then the denominator is invested capital. So the next thing we need is to figure out what the invested capital is. Again, some accounting textbooks or classes will calculate invested capital by starting with total assets and then subtracting all the operating liabilities like accounts payable, taxes payable, rent payable. I do not advise doing that. It's much easier to just locate the capital, and the capital is the equity and the debt. In this case, we have equity of 63.1 and we have debt of 122.7. Add those together, you get 185.8. Okay, pretty simple. And then to get ROIC, we just divide one by the other. ROIC equals the net operating income over the invested capital, which is equal to a massive 52.2% return on invested capital. So what this means is that every single dollar of capital that Apple gets and puts into its business, it uses each dollar to generate a 52.2% return. All right. So we're already doing really well. But that's just the ROIC up here. We also need to figure out what's the bonus effect for shareholders of using leverage, of using that debt. And to figure that out, we have to calculate a few more things. The first, again, you can do it in a couple different orders. You could start with leverage or something, but I like to start with the net borrowing cost. The net borrowing cost is just the after-tax interest rate that the company pays on debt. So in the simple example, I just said it's 5%, right? I just made that up. We need to calculate that here. We've already got like half the numbers that we need if you were doing this in Excel or something, because the net borrowing cost is just after-tax interest dollars divided by the dollars of debt, right? That's the interest rate on debt after taxes. So the after-tax dollars of interest is just the 2.65 multiplied by 1 minus 0.13, which we already did above, okay? Divide that total after-tax interest cost by the total debt, which is 122.7. And if you do the math there, you should get 1.9%. Really low, right? I mean, 1.9%, even back in 2021, that's like less than inflation. So Apple has a really low cost of debt, net borrowing cost. Then we need the spread. The spread is just the spread in the rate of return and the interest rate. So the spread is the ROIC minus the net borrowing cost. So we already calculated those two components. And so we do 52.2% minus 1.9%. The spread, therefore, is 50.3%. So what is this saying? Apple issues debt, right? Issues bonds or takes a bank loan or whatever. They pay those debt holders 1.9%. That's what they pay the debt holders, a measly 1.9%. And then they turn around and use that money to generate 52.2%. The difference between what we have to pay the debt holders and what we can generate with that money is called the spread. And that's the bonus percentage return that's going to come to equity holders. All right. Except there's one more step here. And that is we have to consider what portion of the capital is debt versus equity, right? The bigger the magnitude of the use of debt, the bigger that percentage effect is going to be. Okay. And so the last step is to calculate, well, the last step before we calculate the overall leverage effect is to calculate the leverage ratio. And the leverage ratio in Advanced Dupont Analysis, it's not assets over equity, it's not liabilities over equity. As we did in the simple example, this is our core, what you learn in finance class leverage ratio. It's just the raw debt to equity ratio. So the leverage ratio is the 122.7 divided by 63.1, which equals 1.94. Okay. So for every dollar of equity, Apple has $1.94, almost $2 of debt. All right. So to figure out the leverage effect is going to be equal to the leverage ratio, 1.94, multiplied by the spread of 50.3%. And if you do that, you get an insane 97.9%. 97.9%. So this company generates a core return of 52.2%, and then it magnifies that or augments that with an additional 97.9% leverage effect when we're talking about what comes to the shareholders. And so this big analysis up here, okay, ROE equals ROIC plus the leverage effect. So the ROIC is 52.2%. The leverage effect is 97.9%. Therefore, the ROE is going to be 150.1%. So you've got the ROIC, right? The return on all the capital invested. And then the effect of leverage on the return to shareholders is an additional 97.9%. So shareholders are getting a return of 150.1%. So that's ROE equals ROIC plus the leverage effect. You can double check that, by the way. You always should. You should always double check your stuff. We can calculate return on equity the easy way, which is just net income over equity. You do 94.7, right? This guy divided by this guy divided by 63.1. And if you do that, I believe you will in fact get 150.1%. Okay. So this whole advanced DuPont analysis is just a way of breaking down the company to look at, you might just calculate ROE and you get 150.1%. And you're like, wow, that's amazing. How in the hell did they do that? Right. And so this advanced DuPont analysis just breaks it down and says, and for Apple, they're just super amazing. I mean, you can hate Apple, but they're super amazing in generating returns. So the answer is, well, they have a 52.2% core return. And then they've got this really cheap debt at 1.9% that they invest, and they earn a 52.2% return. They turn around and pay the debt holders only the 1.9%. And then equity shareholders, right, the stock investors, can pocket all the rest. And that's the additional 97.9% leverage effect that we calculate here. All right. Okay. So that is ROIC. And as I told students in the session when I was not recording, I'm going to post at least one other example. I think I have this for Amazon so that you can walk through this exercise yourself with another company. So I'll have the solution there as well. I'll post that in the Google Drive folder that is available on Canvas. And so that should just get updated in that folder when I post it. Okay, there are a couple caveats though that I went over in the session, and so I want to do it again here. First, well, look at all the data here that I have, right? I gave us interest expense. I gave us total debt, right? So even in the more complex example, I'm still pulling the numbers and kind of copying and paste them here, but it's not quite that easy most of the time. So first, let's talk about interest expense, okay? So for interest expense, it's not cut and dry. What exactly is interest expense? And usually the number that you see on the income statement is not the right number. And some accounting classes and a lot of finance classes usually confuse this issue, or at least just don't go into enough detail to help you figure out what interest expense is. A lot of them will actually have you looking at other income or expense, or will have you looking at net interest expense, or it might even be called something else. But usually that is not actually interest expense. It's usually potentially a bunch of different things all merged together into one number. And I'll use Apple as an example. This is what actually, this is even a little bit nicer. I've formatted it to look a little nicer than Apple's real income statement. But this is basically what Apple's income statement looks like if you go pull it up for 2021. And they have, so you get down to this operating income subtotal, and interest expense always comes after operating income. And so a lot of classes will say, look, here it is, other income expense. First of all, the title of that should immediately like clue you in that something's not right. It doesn't say interest expense. It says other income expense net. Second, and I've had a bunch of students over the years come to me confused. They're like, how is interest expense positive? This is a positive number here. Okay. So it's like, it looks like Apple's not even paying interest expense. It looks like the creditors are paying Apple, right? That can't be possible. All right. So what you have to do for most companies is you actually have to go to the footnotes of the financial statements to find out what the heck is in this other income expense. What's the actual amount of interest expense? Every company is going to have it in a different footnote. It's good that we have computers these days because you pull up the annual report or the financial statements. It's usually either in like HTML, like a web page, or it's in a PDF file. And either way, you can just hit Alt F or find, right? Or search and just search for the term you're looking for. In this case, you'd search for interest expense, right? And just enter until you'll go down. You'll probably pick up a lot of different stuff, but eventually you'll get somewhere that looks like it's explaining this is how much interest expense we had this year. So I went and found that for Apple. And you can see down there with those arrows, I manually, this is the income statement modified by me, I manually separated out interest expense versus all the other crap that was in there. And you get a totally different picture, right? Because you can see Apple did pay interest. They paid 2.6 billion in interest, which is what I had on the prior slide. Okay. It was just masked by this other income and expense that was even higher than that, right? Of 2.9 billion positive. Okay. So this is what the footnote looks like. And again, there's no magic. I just Alt F, I just searched for the term interest expense, got to this footnote that explains what is in other income expense. Okay. And you see a bunch of interest and dividend income, totally irrelevant, okay, to us right now. Some other minor expense. And then there's where I got the interest expense. It's right there, interest expense. Okay, so you just got to be careful. Every company is going to be a little different. They might have different titles of line items. They're going to have a footnote that explains what all is in there. All right, that's interest expense. The other thing that I wanted to share is let's talk about the debt, because I also listed for Apple 120 whatever billion of debt. But debt usually is not just one simple line item. You can't just go to the balance sheet usually and find something that says debt, okay? You might see notes payable. You might see bonds payable or just bonds. You might see long-term debt. You might see short-term debt. You might see current portion of long-term debt. You might see commercial paper, which is a really short-term duration of debt. So you might see bank loan. So there's a bunch of different line items, and you kind of have to use your intuition and your finance and accounting knowledge to intuitively kind of figure out, okay, where's all the debt? All right. So this is General Motors that I'm sharing right now. And look what's here. If we look down the liabilities and equity, okay, so first of all, accounts payable is not debt. We're going to talk about that in a minute. That's supplier financing. So accounts payable is not debt. But look, the next thing is short-term debt and current portion of long-term debt. All right. And guess what? It's further broken out into two different line items, automotive debt and GM financial debt. And they tell us we can go read about this in footnote 11. We don't necessarily need to do that. But the important thing is there are two different numbers just for short-term debt. There's about roughly 2 billion and then another roughly 37 billion. Then we go down to non-current liabilities. Oh, they also have long-term debt. You can read about that in footnote 13. Oh, by the way, not all companies tell you right there where the footnotes are. They're not all that nice. That's why I use the search function usually. They've also got automotive and GM financial long-term debt. And not surprisingly, because most debt is long-term, there's even more long-term debt than short-term debt, right? 60 billion plus 16 billion. So if you kind of eyeball this, GM has 76 billion in long-term debt, and they've got 39 billion in short-term debt. So they've got something like 115 billion in debt. So for Apple, I had to do the same thing. I had to go through and find all these different line items and then subtotal it all together to find out what the debt is. And so that you would have to do that yourself manually if you were doing this for a company, your own company that you're focused on. The other thing, speaking about how every company is different, I went up And I just pulled these statements up during the break from our session. So I had no idea what I was going to see. And I was a little surprised and confused looking at this. But let's look for General Motors. So again, we know usually operating income, it should be after operating income or loss that we see interest expense. And this is almost even more deceptive because first you think it's really nice. You're like, oh, wow, interest expense is right there, right? They've broken it out. And then they have their, unlike Apple, right? Apple put their interest income and equity income and stuff, they lumped it in with interest expense. So you're like, oh, well, GM's telling us what the interest expense is. Look, it's 987. But then I remembered, no, because General Motors has automotive debt and GM financial debt. And this only says automotive interest expense. Plus, just eyeballing it, it looks way too small. 1 billion on 115 billion, right? 1 billion interest on 115 billion of debt. I don't think GM is paying less than 1% interest, okay? And so I scoured the footnotes and I looked all over the place. And again, this is just during the 15-minute break, so I didn't have much time. And then I saw it under cost and expenses. GM financial interest, operating, and other expenses, almost $9 billion. So there is a footnote for this. Notice they don't tell you where the footnote is for this one, but there is a footnote that breaks these costs down and tells you what the GM financial interest expense was. And it's another like 2-point-something billion. So most of the interest expense in General Motors case is hidden in this other line item, right? Way up there, because companies can be complex in their structures, in their ownership structures, their financial structures. So I guess the moral of the story is just be really careful and use the search function in your annual report to search for whatever you're looking for, debt, interest expense. You might want, if you're going to analyze debt, go read every single footnote about debt. Okay, go read every single footnote about interest expense. Okay, but that's really just kind of a side issue, an important one, but a side issue nevertheless. Okay, so I think the last thing that I failed to record was discussing turnover ratios before we get to our next in-depth analysis. So I want to make sure this is on the recorded video as well. Although my voice is now giving out, I'm now hitting like 4.5 hours of talking overall this morning. So forgive me. So turnover ratios, they are the last type of profitability analysis that we can do. And you'll notice we've been dealing with one turnover ratio several times today, and that's asset turnover. Remember, that was part of the DuPont ratios for return on assets and return on equity. How productive are the assets in generating sales? So you might want to do a breakdown of that and figure out, well, what part of the assets is particularly productive, right? Where are the strengths and weaknesses in terms of the efficiency of the assets? And so the main breakdown of assets is long-term or non-current versus current, right? And so I've broken it. That's the first breakdown. Now, if you think about what's in non-current assets, usually the only asset that's of relevance or interest to the operations of the company usually is property, plant, and equipment, PP&E. And so people will calculate a PP&E turnover ratio. How efficiently is the company using PP&E? How much sales are generated for each dollar of PP&E? You can do the same thing for current assets, right? How efficiently is the company manage its current assets? And then you can further break down current assets into the components that we know are in there. Usually the most relevant ones are accounts receivable and inventory. And these two ratios are the main reason that we call all of these turnover ratios, because these two ratios are the ones that are usually interpreted as how many times per year does this account turn over? So you might have heard of inventory turnover, okay? How many times per year does inventory turn over? Meaning how many times per year do you sell your inventory on average, right? Do you sell inventory 10 times per year, 1 time per year? What is it? And accounts receivable turnover is how many times per year do you collect accounts receivable? And then finally down here, we have kind of like the odd man out, a liability turnover ratio, accounts payable turnover. And what we're going to do an analysis with that in a little bit, but the main reason we have that is because it's the flip side of accounts receivable. Accounts payable is how many times per year do you pay your suppliers, right? So you've got accounts receivable turnover, how often do you collect from customers? Accounts payable turnover, how often do you pay suppliers? Okay. So the other thing to note here is that most turnover ratios have sales in the numerator. Okay. Because we think about, well, assets generate sales. You know, we're usually focusing on sales as the ultimate metric of, you know, company growth and stuff like that. But inventory and accounts payable do not use sales. They use COGS, which is my abbreviation for cost of goods sold, right? So an income statement is sales revenue minus cost of goods sold. So that's usually like the second item, right? Sometimes it's called cost of sales. We use that in the turnover ratios for inventory and accounts payable because you may remember this from managerial accounting or maybe even from financial accounting. What is in inventory? Inventory is the cost of the products as they were produced. Okay. It's like, so if we were talking about Apple here, Apple's inventory, the iPhones, the MacBooks, and all that stuff, that inventory is recorded at the cost to Apple of producing that inventory. Sales revenue includes an additional potentially huge fudge factor, which is the price markup, right? The profit margin that they charge to consumers. So when inventory is sold, right, it affects two things. It affects sales revenue and it affects cost of goods sold. But the journal entry when inventory goes out the door for the inventory part of it is literally debit cost of goods sold, credit inventory. All right. So dollar for dollar, when inventory leaves the company, it is reflected in cost of goods sold, not in sales, because sales includes the additional price markup that they hose you and me with. Okay. Same idea with accounts payable. Accounts payable is money owed to suppliers. What do companies get from suppliers? Inventory, right? Or the raw materials that go into inventory. So again, it's really more appropriate to link what we owe suppliers to the cost of those products. Now, small caveat, technically we would want to do for accounts payable, we would want to have inventory purchases in the numerator, but that's more complicated to calculate. And over time, it tends to smooth out and be roughly the same thing. So cost of goods sold is a decent shortcut for it. Okay. So those are our turnover ratios. They're pretty easy to calculate, one number over another number, and we will do a little bit of it in an exercise in a minute. But I'm assuming that unlike advanced Dupont analysis, you guys shouldn't have much problem doing one number divided by another. So I've already done that for us in this exercise. But we saw earlier in Dupont analysis that Best Buy had substantially higher asset turnover than GameStop. And we might be interested in what are the drivers of that? Which assets is Best Buy using more efficiently? Excuse me, I'm going to cough. Just too much talking. I have a small bit of bronchitis that will not go away for like 2 years now. So, all right. So we saw in the DuPont analysis, this is what we calculated before. If you may not recall by now, we've seen too many numbers, but Best Buy had $2.93 in sales for every dollar of assets. GameStop had 1.9. So Best Buy has a whole additional dollar of sales that they're generating per dollar of assets. Why is that? Is it their long-term assets? Is it their short-term assets? Well, let's jump down to the only long-term asset that we usually calculate this for, property, plant, and equipment. Is Best Buy doing better than GameStop? So for most turnover ratios, the higher the better, because it means they're turning over more frequently, right? They're generating more sales. Yeah, 9.08 is in fact higher than 8.49. Is it like extraordinarily higher? No, it's not even 10% high. It's like 5% higher or something, right? Just eyeballing it. So yes, Best Buy is managing its PP&E a little more efficiently, but nothing insane. All right, so that doesn't really explain the huge difference. Let's look at current assets. Okay, now we're getting somewhere. Okay, so Best Buy has twice the current asset turnover of GameStop. Huh. So something about GameStop's current assets just they're not being efficiently utilized. Well, let's go look at accounts receivable and inventory. The two ratios that can be interpreted as how many times per year something happens, right? And it's very high for both companies. Accounts receivable for Best Buy, they collect their accounts receivable 40.6 times per year. GameStop collects their accounts receivable about 42 times per year. So it's actually reversed here. GameStop is actually doing a better job, or they collect cash from customers faster than Best Buy does. So that doesn't explain it. What about inventory? And inventory turnover is like the bread and butter of being a manufacturer or being a retailer. What do? You produce and or sell inventory, right? And so you want to see, that's the critical metric here, usually. But again, not a huge difference. I mean, Best Buy sells its inventory about little over 7 times per year. GameStop is closer to about 6.7. Yeah, Best Buy's doing better, but again, by about like 5%. So before I tell you what's really going on here, because you can't tell from these, unfortunately, you would just have to start going and digging deeper into the balance sheets. And it's because GameStop had a very peculiar year last year. So what we can conclude here is Best Buy is doing better. It's using its property, plant, and equipment more efficiently. It's selling its inventory more efficiently, faster. It's not quite as good at collecting accounts receivable, okay? So then why the huge difference in current asset turnover? What's, for most companies, the other current asset that we're not seeing here? Cash, all right? And so that is what's going on with GameStop. They have a ton of cash sitting on their balance sheet. And guess what? Cash isn't productive. There's not even a point in doing a cash turnover ratio because cash doesn't generate sales, right? It just sits there. And so GameStop has something like $1.2 billion of cash sitting in its assets. And that's why it looks very unproductive, because it's got assets that don't generate sales. Why does it have that? Is it because GameStop's amazingly healthy? Well, they have all this cash. No, it's because GameStop almost went bankrupt the year before, and they saved themselves by the skin of their teeth, issuing $1.6 billion in new stock, mostly, I guess, to Reddit investors. So they got this huge cash infusion to save their lives, and there's still 1.2 billion of it sitting on their balance sheet. Okay. All right. The last one, accounts payable turnover, not part of asset turnover, because it's not an asset, it's a liability, but it tells us how many times per year the company pays its suppliers. Notice it's much lower than the accounts receivable turnover. So these companies are collecting 40-ish times per year from their customers, but they're only paying their suppliers, for Best Buy, 5.6 times per year, and for GameStop, 8.6 times per year. Now, is a higher turnover ratio here, is that good or not? As you'll see in analysis shortly in a couple slides, most people would say it is not good to pay your suppliers quickly because then you don't have cash on hand, right? Like if I could avoid paying my supplier for 6 months, I would like to do it. Now, a lot of companies can't do that. A lot of financing is like they only give you 1 month or 2 months to pay. But so Best Buy pays 5.6 times, GameStop 8.6 times. So most people would say Best Buy is doing better on this because Best Buy is able to negotiate better with its suppliers so they don't pay as quickly. All right. Now, speaking of quickly, these turnover ratios, especially accounts receivable, inventory, and accounts payable, it's how many times per year the account turns over. So how many times per year receivables are collected, how many times per year inventory is sold, how many times per year accounts payable is paid. And because we know there are 365 days in a year, we can convert these turnover ratios into how many days it takes that thing to happen, right? So, for example, it takes Best Buy 365 divided by 40.61, or in other words, 8.99 days to collect its account receivable, right? So if you're collecting 40 times a year, right, and there's 365 days in a year, you can almost just ballpark that. 36.5 divided by 4, yeah, that's about 9, right? And so that's what it ends up being, about 9 days to collect its accounts receivable. So really fast. So Best Buy customers pay, almost within a week on average. Part of that is because Best Buy doesn't have a lot of customers that get credit, right? Like if you or I go into Best Buy, they're not going to be like, oh, yes, sir, you can pay us in 2 months. No, you better pay right there. They're going to stop you at the door and ask for your receipt, right? So companies that don't do a lot of business to business work will have higher accounts receivable turnover. All right. And I think this is where I started recording again. But just in case, I'll review this just a little bit. So the operating cycle, the idea of an operating cycle is to measure how long it takes a company to do its main line of business, to convert inventory into cash, for example. Okay. Like for Boeing, it would include how long does it take to build an airplane and get it to the customer? And that's years, right? But for, like a grocery store, how long does it take to sell a banana? 4 days, right? And so every company, every industry has different operating cycles. And the idea is you can compare the efficiency of operating cycles between companies using this analysis. But we're also going to look at a different outcome that tells us how many days of financing, of additional external financing, like either issuing stock or issuing bonds, taking a bank loan, how many additional days of financing does a company need to cover its operating cycle? So the operating cycle, you can talk about that very qualitatively, right? It takes years to build an airplane. How lean is your manufacturing environment? Blah, blah, blah. How much force can you exert over customers to pay you quickly? But this is a very quantitative analysis because we know from those turnover ratios, we can explicitly calculate on average how long it takes a company to sell inventory, how many days. We can calculate how many days on average it takes to collect cash from customers. Bam, that's the operating cycle. The only addition that we're going to do to figure out how many days of financing it takes, right? Because maybe your operating cycle is 50 days long. Then the question is, well, how are you going to get cash for those 50 days, right? You're producing the inventory, you sold it to customers, they haven't paid you yet. What are you going to do? Just not pay your employees, lay down and die, right? So no, you need some kind of financing. And the nice thing is, though, we also might be able to use supplier financing, the accounts payable that we owe to our suppliers. So if your operating cycle is 50 days, but you can wait 50 days to pay your suppliers, you don't have a problem, right? Because you can literally make your inventory, sell to the customers, collect from the customers, then turn around and pay your suppliers, and you're good. You don't need extra financing. So the last thing the adjustment we're going to make, we're going to use days inventory plus days receivable. That's the operating cycle. Then we're going to subtract the days in payables because that's your supplier financing buffer. Okay. And then whatever's left over at the end of the day, there might be some residual days where you'd be sitting there without cash. And so, okay, go get a bank loan, go issue stock. That's why companies, raise funds. All right, so we'll see this in action here with GameStop. And GameStop's actually, it's not as bad as I thought it would be. But again, GameStop's been getting better year after year. I mean, they looked like they were going to die literally like a year or two ago. They looked like they were going to die that year. And then fortunately, the Reddit investors were willing to give them $1.6 billion. I mean, that's basically what saved GameStop. So we'll see how long it saved them for. But all right, let's look at GameStop's operating cycle, okay? So we want to figure out the total days financing needed. But first, let's figure out its operating cycle. So its operating cycle is how many days to sell inventory plus how many days to collect from customers, okay? Now, one reason, by the way, that Best Buy and GameStop both collect from customers really quickly is because a lot of customers don't get credit, right? Like you and me, the individual consumer, generally, we don't get credit from retailers. I mean, sometimes we do. Sometimes retailers have actual, in-house credit that they give people, in-house credit cards, but it's pretty rare. So that's one reason why they collect so quickly is because they don't give credit to that many customers, right? They probably only have a few big customers that buy enough bulk of video games or systems or whatever to resell that they actually get credit. All right. So first we'll do how many days it takes to sell inventory. Okay. So the days of inventory is going to equal 365 days divided by the inventory turnover ratio. And the inventory turnover ratio is cost of goods sold divided by inventory. Always remember, cost of goods sold is in the numerator because when inventory gets sold, it goes into cost of goods sold. Okay, so that's 4555 divided by 683. And if you do that, you should, if I did my math right, I hopefully I did. It takes about 54.7 days for GameStop to sell its inventory. So what does that mean? I think we saw, yeah, I think that intuitively, I think I did that right, because GameStop's inventory turnover is 6.68, I think. And so if you're selling a little less than 7 times per year, this looks about right. So it's taking you 54.7 days to sell. So that literally tells you, as next time you're walking through the mall and you see the GameStop store with nobody in it, right? Or a kid, you know, a 25-year-old crying for his mom to buy him the system, right? Then think to yourself, well, okay, the average video game or toy or whatever sitting in here that I see sits there for about 2 months, right? A little less than 2 months. Okay. Does that make sense? I guess it makes sense. It makes sense intuitively to me, I guess. Okay. So then we want the days in receivables. Which is going to be 365 divided by the receivables turnover. Now we have sales in the numerator, okay? Because accounts receivable is money that customers owe, and customers owe on the MSRP, right? Or on the markup. So customers owe money on the actual sales number. So that's why sales is in the numerator here. So that's going to be 5927 divided by the accounts receivable of 141. If you do that, you should get 8.7 days. So on average, GameStop customers pay in just a little over a week. Okay. Now, some of this might be, you know, people doing stuff on layaway or something like that. Some of this might be special promotions or something, but most of it is just the fact that, you know, 99% of GameStop customers come in and just pay on the spot. And there's probably 1% that are larger, maybe other store type customers that buy in bulk and get some credit. But on average, across all those types of customers, on average, the customer pays in 8.7 days. All right, then we have the days payable. The days in payables is 365 divided by, again, cost of goods sold in the numerator, because this is what we owe suppliers. And we owe suppliers for the cost of the inventory. So again, we've got 4555 divided by 531 in payables. Mute that. So the days payable is 42.5 days. So that's actually better than I expected, especially because, so we're not doing it here because we have limited, you know, time on what we can do. But if you look at Apple collects pretty quickly from its customers, not as quickly as GameStop, but because Apple has a lot of, you know, university clients and business clients, but Apple collects pretty fast. But Apple takes forever to pay their suppliers. Like Apple takes 3 months or something to pay its suppliers. To GameStop, I thought they'd have to pay their suppliers immediately, because if I was a supplier of GameStop, I'd be incredibly scared that GameStop's going bankrupt. So the fact that they're able to wait, you know, a month and a half to pay their suppliers is actually quite good. So if you want to look at, I'm gonna have to move up here, but if you want to look at the days of external financing needed, what you do is you look at the operating cycle, which is the days to sell inventory plus the days to collect. And so their operating cycle is what, 63.4 days operating cycle. But then you subtract the days that they're able to avoid paying suppliers, because that's their buffer. That's their supplier financing buffer. And if you do that, you get 20.9 days of external financing needed. So we learn a few things here, right? We learn how long it takes a company to sell inventory, how long it takes to collect from customers, the buffer that they get by avoiding paying their suppliers, And if you put all this stuff together, we come up with kind of a, how constrained is the company in terms of financing? How many days of that cycle does it need to rely on other types of financing to stay afloat? Okay. And, if you do this calculation for Apple, I haven't done it for a couple of years, but generally Apple's result is negative. Apple doesn't need any Apple needs negative financing because it takes so damn long to pay its suppliers, and it sells its inventory in like 2 weeks, sometimes faster. So Apple has a negative result here, but most companies will have, a few weeks to a few months of external financing needed. And some of the bigger manufacturers like Boeing, it might be a year of financing. I don't know. I've actually never done that. Does anybody have questions about this? Okay, so this kind of bridges the gap between profitability analysis and credit analysis, which we're going to get to right now, because we've moved to talking about, even though we always kind of had debt there because we were talking about leverage, but now we've done an analysis using some profitability turnover ratios, but that tell us something about how much external financing a company needs. So that brings us to credit ratios. All right. And credit ratios, rather than asking, gosh, what kind of return is the company generating? Now we're going to dig in more to the riskiness, the effects of leverage. Okay. And generally, there are 3 types of credit ratios. Again, everyone kind of disagrees. I mentioned this at the very beginning of the lecture: liquidity, solvency, and coverage. Liquidity is generally short-term. Solvency is long-term, and coverage could be either. Now, luckily for us, actually, that's probably why these different types of analyses evolved, because how do the financial statements present to us? Look at the balance sheet. The assets equals liabilities plus equity is there, but then the main breakdown of assets and liabilities is current and non-current, right? So you have the current stuff is everything that is going to be transformed into cash or have to be paid within the next year. And then the non-current is everything that's more than a year away. So what these ratios are generally going to do is liquidity, looking at the short term, liquidity ratios will be looking at the current assets and current liabilities. Solvency, as a longer term thing, might be looking at all assets and all liabilities, or it might be looking at only long-term liabilities and things like that. So that's what we're going to see. And then we'll get to what coverage is in a minute. So first, just to briefly talk about uses of debt. And I'm going to do this really brief. This is more, I pulled some of these slides from another class I teach, and I don't think this is super relevant for you guys, but as we're talking about debt, right? Like why the heck is a company taking on debt? And we saw that debt can explode the return on equity and either help shareholders or really hurt shareholders. But this is just the way I think about debt. It's broken down like the statement of cash flows. If anybody was here for my valuation session, you guys know I love the statement of cash flows and how it relates to valuation. But so the cash flows has the operating section, the investing section, and the financing section, right? And so you might use debt to fund operations. That's what we were just now talking about, right? With the operating cycle, you can't be sitting there without cash. So you need some level of external financing. Could be equity, could be debt. So you could use debt to fund cyclical, I stress that, operating needs, okay? The problem here is when you start taking on debt on a regular basis to fund your operations, right? Because eventually your operations are supposed to be self-sustaining, right? Like the company needs to be earning enough money from its core business to stay alive, right? You can't just keep taking on debt forever. So you might be worried about companies that take on debt to fund operations, okay? This is the more common use of debt to fund the investing activities. And for those that, this is a refresher for those that were here in my last session, new for those who weren't, but the investing section of the statement of cash flows, that's what finance people or finance classes refer to as CapEx or capital expenditures. So the investing section of the statement of cash flows, that's your CapEx. The biggest part of that usually is property, plant, and equipment, right? You bought a new building, you bought a bunch of new delivery trucks, stuff like that, right? You open new store locations. That's CapEx, that's the investing section. And that's where debt is most commonly used, right? A mortgage on a new property, okay? a loan taken out to fund the construction of a new facility. Okay, so that's primarily where debt, and that's a good place generally to use debt, because those investments are the core of what generally is going to lead to returns in the future. Right? You can't sell products without stores, right? You can't manufacture products without a manufacturing facility. So that's kind of a reasonable way to use debt. And then weirdly enough, the financing section of the statement of cash flows, all that's there is cash flows to the capital, to debt and equity. So that's literally loan repayments, dividend payments, and stock repurchases down there. And so you're like, well, what do you mean use debt? Use debt to fund financing. Debt is financing, right? Well, there's two ways this happens. It's very common. Take out a new loan to pay off an old loan. Okay, so companies just perpetually refinance a lot of this debt. This is why a bunch of people are worried right now, by the way, with the Federal Reserve. We've had to raise. I'm not a Federal Reserve bad type of guy, but the fact that we've gone from like 0% interest to like 5% or whatever it is, a lot of people are worried that because these companies have been so used to refinancing their debt, it's such a low rate, right? With Apple, we saw 1.9%. And now even the treasury bills are like 4-something%. And so when these companies coming and refinance their new debt, so that's debt to fund debt, they're in for a shock, right? Because they're paying like 500% or something, maybe for some companies, what they had been paying. And then the other thing is, this is what, and Ron brought this up earlier, this is what Apple has been doing for the last 10 or so years, is as you become less risky, it actually makes sense to take out debt at 1.9%. And you can turn right around and repurchase stock and pay dividends to shareholders, which is what shareholders are consistent with the last session that I taught. That's what shareholders ultimately want, right? They want money back. And so debt can be used to fund a lower cost way to return capital to shareholders. Okay. All right. So that's the uses of debt. Let's talk about how we analyze the riskiness of a company from a debt perspective. All right. So liquidity analysis is short term. So you're not going to see a lot of debt. I mean, a company might have short-term debt. A lot of them do, but it's usually not a huge amount of their debt. But liquidity analysis focuses on the ability to meet short-term obligations, okay? And as a result, it's going to involve usually current assets and current liabilities. I always like to link back to how they talk about stuff in finance classes. In finance classes, you'll hear a lot about working capital or net working capital. Working capital is just current assets and current liabilities. Net working capital is current assets minus current liabilities. So if you want to, connect what you learned about in the accounting class to how they talk in finance, current assets and current liabilities is working capital. All right. And the first and probably the biggest ratio for liquidity analysis is the current ratio. The current ratio is just current assets divided by current liabilities. And luckily for us, this is not one of the hard ones. Remember, I showed you, it's like, well, you got to find all the debt line items. Current assets is always a subtotal in the balance sheet, and so is current liabilities. So you will be able to go in there, find total current assets, total current liabilities, and just pull those numbers out, okay? This is one of the few ratios where there's a pretty clear rule of thumb, and the rule of thumb is you want to see it generally around 1. Some people used to say, oh, it's okay if it's less than 1 because just-in-time inventory and companies are trying to be lean and all these buzzwords. But at the end of the day, why do you want to see current assets divided by current liabilities be approximately 1? Why does that matter? Well, current assets, this is literally just the accounting rules. Current assets are the assets that are expected to be converted to cash within 1 year. Okay, so that's like the total potential cash you're going to have. And current liabilities are the obligations that you have to pay within the year, right? And so if this ratio is equal to 1, what that means is that, congratulations, the company can precisely cover its current obligations, right? If it's below 1, something needs to change, right? I mean, they either have to sell inventory really fast or get a cash infusion from somewhere else, because they're gonna have to pay those current liabilities. All right. So as you can see, kind of consistent with this, Apple's current ratio and they're a very healthy company, obviously, but their current ratio has consistently been above 1. When the current ratio gets too big, sometimes people start asking questions like, why do you have so many assets? And there's literally been countless news articles written about Apple over the years about why do you have $250 billion of marketable securities and another 150 billion of cash or whatever it is. Like, your assets look kind of bloated, but Apple's kind of come back down to a reasonable level. But we'd be scared if it was 0.5, we'd be scared because we're like, oh my God, you can only pay off half of your liabilities, right? If that's 0.5. All right, so that's the current ratio, just a metric of, can you pay off your obligations this year? And then there really only there's a bunch of little variations on a bunch of ratios. I'm just kind of covering the usual suspects, or the ones I like, I guess. But these are the important ones, I think. Quick ratio is the only other one we're going to talk about. And the quick ratio is just a slight modification of the current ratio. What does it say? And there's also about 5 different definitions of the quick ratio, okay? And balance sheets aren't quite as simple as we might like to think in like accounting 101. So they don't always, sometimes the different definitions can give you the same result. Sometimes they don't if it's a more complicated company. But what's in there? Cash plus marketable securities plus accounts receivable. For those who weren't here last time, marketable securities is just when one company buys the stock of another company, like in a regular like trading, or buys, treasury securities or something. Marketable securities are just like a company's personal investments that it's using just to earn a return on its cash temporarily until they sell it. So what's missing from the numerator here? If you think about what, right, the current ratio is all current assets in the numerator. This one, and that will be the other definition of the quick ratio. It's basically current assets minus inventory, right? That's the main current asset we see missing here from the numerator. There's no inventory. And so the reason why this is kind of the more conservative measure, and they'll especially be more likely to use this measure when a company's struggling. Like when we're worried that GameStop might not be selling its inventory very well, right? Or stuff like that. Or Bed Bath & Beyond, right? We're actually going to do some ratios for Bed Bath & Beyond in a minute here, right? Where you're like, God, nobody's going to the stores anymore, right? They're about to go bankrupt. Are they even going to be able to sell that inventory? And so then we calculate the quick ratio and say, well, let's assume they can't sell their inventory. Now, how much of their current obligations will they be able to pay? And this is always going to be less than current ratio, obviously, because at the very least, you're taking inventory out of it. And you can see for Apple, still, Apple has been usually right above or right around 1. They're a little bit below that in 2021, but that's fine for the quick ratio, especially for companies that rely on selling inventory, because you're removing the inventory. Okay, so that's the idea of the quick ratio. Questions about that? Okay, again, not too this is way less complex than what we were doing before. Okay. Oh, and here it is. So Bed Bath & Beyond, BBBY, right? Not to be confused with BBY, which is Best Buy. I was actually reading on Wall Street Bets on Reddit a few months ago, that because Bed Bath & Beyond was another one of these like meme stocks that everybody was investing in. And there were a couple people that posted that they bought, they bought like $50,000 in call options or whatever. And they meant to do it for Bed Bath & Beyond, but they did it for Best Buy instead, right? Because it's BBBY versus BBY, and then everybody's like making fun of them or whatever. I'm not sure. It's probably a good thing they accidentally bought Best Buy. It's probably a better idea. Okay, so let's just calculate the current ratio and the quick ratio for Bed Bath & Beyond here. And now we're not, so up until now, we've been comparing like two companies, like a company to another company. Now this is like a time series analysis. Let's look at what general picture do we get of Bed Bath & Beyond last year versus this year, okay? All right, so the current ratio, so for 2022, right, the current ratio, these are pretty easy, right? It's just current assets over current liabilities. So current assets is 2363, current liabilities is 2075, and if you do that, you get 1.14. Not bad, right? I mean, Bed Bath & Beyond was becoming a meme stock back in 2022. And just from this single analysis, they actually look okay. Like, wow, they can pay their obligations, right? But the side of it we're not seeing here is their really bad earnings, right? Their really bad income statement we're not seeing here. Okay, let's do the quick ratio, right? Because what if we're worried Bed Bath & Beyond can't sell the inventory, which we should be worried about that. We already knew back in 2022 we should be worried about that. So the quick ratio is just the non-inventory current assets, which for them was just a cash and accounts receivable. Okay, so we do 440 plus 27, right? That's their quick assets, and we still divide by the same current liabilities. We do that and we get 0.23. Ooh, so like 90% or whatever of the current assets are inventory. So, this company, if they can't sell their inventory in a timely manner, they're not even going to be able to pay a quarter on the dollar of their liabilities that year. Okay, so that's a little worrisome. All right, a lot of times with companies, the quick ratio, like we saw with Apple, if the current ratio is 1.14, you might see a quick ratio of 0.75. But when it drops to 0.23, you maybe start getting a little scared. Okay, well, let's look at what happened. Should we have been worried or not? Well, let's move to the future. And the current ratio in 2023 is 1097. I won't write out the title again. 1097 divided by 2496. Okay, so the current ratio this most recent year is down to 0.44. So even including the inventory, they can't even meet half their obligations in 2023, half of their current liabilities, right? They're at 44%. All right. What about the quick ratio? Assuming, again, now we should be even more concerned if they can sell that inventory or sell that inventory at above cost, right, at least. So their quick ratio is now 66 plus 16 divided by 2496, which is equal to, this is really insane, 3%, right? So if Bed Bath & Beyond can't sell that inventory, they're going to be able to pay 3 cents on the dollar of just their current liabilities this year, okay? Which is, I think it's the worst I have ever seen. Not that I've done like a million of these, but I've done like hundreds. So this is pretty bad. All right, so that's the current ratio and quick ratio. And you can see in this example, we're not comparing it to a competitor, but you just look at massive deterioration over time, right? And so another interesting thing to do is to see over time, is a company getting better? Is a company getting worse? Some people look at trends in companies under different CEOs, right, to see who's managing different parts of the business better. And did he drive more asset efficiency, or did she pay down more of the debt, or stuff like that. So questions? All right. Okay. So that's liquidity. That's short term. I mean, there's only so many ways you can slice and dice current assets and current liabilities. Okay. Solvency analysis is the longer term stuff. And by longer term, we mean long-term debt mostly. Can we pay off? Can the company pay off its long-term debt obligations? Okay. Now, in general, this is going to be a repeat of stuff we've already done. So I'm going to breeze right through it because it's just leverage ratios. So I mean, I think the best way to analyze leverage, we actually already saw it. It was that Advanced Dupont, return on invested capital and the leverage effect. I think that's the best way to analyze the effect of leverage. But just the general risk metrics of, do you have too much leverage or not? The two big ratios are liabilities over equity. Okay, which as we learned, if we just add 1 to this, if we just do +1, we then have assets over equity, right? Okay, so this is Apple's liabilities over equity ratio over the 5 years. So they went from like 1.9 to 4.6 or something like that. So they more than doubled their liabilities to equity ratio. So this does not have a rule of thumb. right? We can analyze this kind of like we did with Advanced Dupont Analysis, but there's no clear point at which you're like, oh, this is too high, right? I mean, every company, its industry, its operations, its strategy, you just never really know what the right leverage ratio is, but you can look over time and you can compare to competitors, right? So if you're kind of looking at an industry and everybody's hovering around a leverage ratio of like 3 or a liabilities to equity ratio of 3, and your company's like 5.5, you might start, what's going on here, right? And start reading about, what management says their strategy is and like, why is the debt so high, right? Because that's risky, as we've seen, that's risky. All right, so there's liabilities to equity. And then there's, again, this is what we did in the Advanced Dupont Analysis. We drilled right down to the just precisely debt to equity ratio, which is the most traditional leverage ratio when you think about finance classes. But again, you got to go find all your different long-term debt and all your different short-term debt items and make sure you plug them all in correctly. Okay. And we haven't seen this one yet, but this, going back to what Ron was asking earlier, this is where you can really see just the raw debt to equity ratio for Apple ballooning up. Okay. And this one's like 2.5 times, larger in 2021 than in 2017. All right. So that's solvency analysis. Okay. So I mean, and again, there's other ways to slice it. Some people just want to calculate the long-term debt to equity ratio. I don't care about the short-term debt. Fine, right? You're free to do that. But ultimately, again, there's only so many ways you can slice and dice a leverage ratio. Chat here. What's my take on the Altman Z-score? I thought about including the Altman Z-score in this lecture, but I was assuming you guys learned that in a finance class somewhere. The Altman Z-score is just a bankruptcy predictor. I mean, research shows that it's a pretty good predictor of bankruptcy. It's from regression models predicting the probability of bankruptcy. I like it. I don't think it makes sense to do an Altman Z-score for like Apple. You know what I mean? Like Altman Z-score probability of bankruptcy is like when you already start worrying about a company a little bit, right? Like sales start going down a little bit, or let's say you calculate the current ratio and it's significantly below 1, right? It's 0.8. Otherwise, the company's doing pretty well, you think, but their current ratio is lower. Their quick ratio is very low. Then I would say, go do the Altman Z-score, right? And because you might be interested in what's the probability of bankruptcy. So
I asked because somebody told me it's not relevant anymore because the leverage ratios.
So the Altman Z-score originally was developed like a long time ago, right? And so that's also true of the Benesch model. Although Benesch just came and presented at this conference we had, it was really random. Like we had a conference on cybersecurity, and all of a sudden, Daniel Benesch was there, and he talked about his model in his paper, and he's redone his model recently, and he's got other working papers that show his model is still pretty predictive. Like it hasn't lost its ability to predict, and it still beats a bunch of models. I'm not a finance bankruptcy expert type person, so I have not kept up with the literature on the Altman Z-score. It used to be really good, but it's certainly possible over time as companies change, right? Ideally, you would want to redo the original big data analysis and determine whether the predictors are still predictive and whether they deserve, because a lot of it's what weight do you put on it, right? The Altman Z-score is about the weights. The weights may have totally changed. Anyhow, I'm not teaching about that today, but good question. So another important note, really important, and this is a really fundamental, hardcore accounting thing that a lot of people don't know about, all right? Leases. All right, it's really common that instead of like buying a building or buying an airplane or buying a fleet of trucks or buying stores, that a company leases them. And it's exactly what it sounds like when you and I decide whether to buy a car and take a loan. Sorry, I've never paid all cash for a car. I never have enough money to do it. So my choices are take out a car loan and buy the car with a loan, or lease the car, right? Same thing with rent or buy for a house. You buy the house with a mortgage. Again, if you can do all cash, congratulations. I have never and will never be able to do that. But you either buy with a mortgage or you rent, right? You rent a house or apartment. And it's the same thing with companies. And a bunch of them are renting or are leasing this stuff. I actually had the example here. So the company is obligated to make monthly payments. And, when you guys, I'm assuming everyone here has rented an apartment. I'm just going to assume that. When you rent an apartment, usually you're on a 1-year lease, right? And I've broken like a million. I always screw up my planning and I have to break my lease in the middle, but it's a 1-year lease usually. For companies, they're big and they're spending a lot of money and they don't like risk. And so a lot of them enter into really long-term leases. Okay. Like when airlines lease airplanes, they might be in like a 20-year lease. All right. And what we found out over the last few decades is that companies were entering into these rental agreements, but the reality was they were using this stuff its entire life. It wasn't like a 1-year lease on an apartment or a 3-year lease on a car. They were leasing the cars for 15 years, right? They're leasing the stores for 30 years. I mean, it's like they bought it, but they didn't. And you might say, well, then why the hell would they, what's the difference? Why would they do that, right? And the answer is an accounting answer. From like 1970 something until 3 years ago, companies didn't have to list any of these assets or any of the liabilities on their balance sheet. So it was like ghost assets and ghost debt. That's the only freaking reason. I mean, there might be some other reasons, but that's the main reason they did it. And finally, the Financial Accounting Standards Board got their, together and changed the accounting standard. So now, thankfully, we see them. We can see these things on the balance sheet, but it's a new way of presenting things that people aren't used to. And a lot of accounting classes still don't really teach it because it's so new. But so you're going to see lease assets. And we talked about plant, property, and equipment turnover, right? Like how efficient is plant, property, and equipment? Well, a bunch of it for a lot of companies, it's not even listed in PP&E. It's a separate line item called right of use assets or lease assets. And then the even worse thing, because we care a lot about debt, right? And how risky is the company? And if you go on Reddit, I know this is not, I like to go on Reddit. It's funny. It's funny a lot of the time. But you go to all the crazy Wall Street bets and the GameStop investors and stuff, and they make statements like GameStop has no debt. Amazing. Like, let's all go invest. Okay. Lease liabilities. This is like payments that the company owes on stores or equipment or whatever for the next 5 or 10 years. And it's very hard to get out of these leases. I mean, you basically have to go into bankruptcy to get out of these leases. So let's look. Let's look at GameStop's balance sheet. This is the assets of GameStop. All right. And we want to see how efficiently are they using their property, plant, and equipment. We just looked at this, right? We looked at their PP&E turnover ratio. And did I make the adjustment? I did make the adjustment. Okay. But if you don't pay attention and you're like, how efficiently are they using their property, plant, and equipment? GameStop appears to only be using 136 million. Look at the line right below it. 560 million of leased property, plant, and equipment. So, it's very easy for a naive investor to look at this and be like, wow, oh my God, they're generating so much sales with barely any store space, 136 million. Like, no, dude, they have 4 times that, more than 4 times that in leased assets, okay? So you always would add that into any ratio looking at property, plant, and equipment. You want to add those leased assets in there. What about debt? What about the liability? GameStop has no debt. Now, actually, they did eventually get, or at some point, they had some kind of loan, although it was pretty small, right? 39 million of debt. Like, they're basically debt-free. Well, except for the $577 million of lease debt that they have, right? So you literally have all these poor investors that put another 1.6 billion in there, and it might be a good, who knows, might end up being a good investment. I doubt it. But they didn't even notice that there's another almost $600 million of debt in the form of lease liabilities. So when you're calculating the debt to equity ratio and stuff like that, or how long, we're going to get to it, coverage ratios in a second, how quick you could pay off your long-term debt, you would want to include these lease liabilities in the debt calculations. Otherwise, you're missing most of it, right? You'd be missing 90% of the debt. It's crazy. So an important side note. Okay. The last type of credit analysis is coverage analysis. This can be short-term or long-term, and we'll look at one of each of these ratios. Sometimes these are called flow ratios because they often use cash flow and income statement data. We're going to look at two of them, and there are multiple ways to define both of these ratios. Some people prefer to put cash flows in there. Some people prefer to use net income or EBIT or something like that. But we're going to look at the interest coverage ratio and then the cash from operations to total debt. We'll talk about what that means in a second. So the interest coverage ratio, what that tells us, this is a shorter term analysis. It is related to how you can pay your debt, sir, how you can service your debt, okay? The idea is, let's forget about the ultimate principle of the loan that you're going to have to pay eventually. Let's just focus on, are your interest expenses too high, right? What's the probability you're going to default on your debt by not paying your interest? And so it's EBIT. And again, it's my very specific definition of EBIT that we'll look at in a second because people define it differently, divided by interest expense. And so it says, let's look at all the earnings you have available and see how many times you could cover your interest expense. That's what this is telling us. And so Apple's interest coverage ratio, it's fluctuated. It's never gone below 20. Now it's like at 40. So what that means intuitively is Apple could pay its interest 40 times over and still end up with positive net income, positive earnings. All right. Now, why is it not net income in the numerator? It's not net income in the numerator because, as we talked about with Advanced Dupont Analysis, interest expense has already been subtracted in net income, okay? So we want to think about income before we've paid the interest, okay? And then the other thing we talked about is interest has a tax shield. It's tax deductible, right? So we also want to ignore taxes here. So we want income before interest and before taxes, which commonly is referred to as EBIT. But it has the same issue that I brought up earlier with the interest expense thing, where like you don't just want to go look at other income, right? Because we don't want to also add back, Apple's interest revenue and dividend revenue. We don't want to adjust for that. We just want to be adding back the interest expense on debt itself. So you might have to, again, go down to the footnotes. What was the actual interest number? And that's what I've done in the example that we'll see in a second. The other coverage one, this is a longer term one. How do we know it's a longer term ratio? Because the denominator is short and long-term debt, all the debt, right? And that debt might not be due for 10 years, 20 years. We don't know for sure. Right, on average, you could calculate it. But so we've got cash flow from operations. So this is cash flow from operations is very similar to, actually, what would you call it in finance? Anyway, earnings before depreciation and amortization, basically. So cash flow from operations is just kind of like a cash earnings. And that's why, again, some people might use net income here. Some people might use net income, add back depreciation. But I think it's simpler just to use cash from operations because that's one number that you can grab from the cash flow statement. All right. So what is this telling us? It's telling us that how much of a company's debt could it pay off with 1 year of its cash flow? Okay. And so if the company's operations are generating strong earnings, generating strong cash flows, then it should be able to pay off more of its debt. And of course, the larger its debt is, the harder that is to do. But what this ultimately tells us is what percentage of its debt it could pay off with 1 year. And this means that it wouldn't be able to do anything else. It wouldn't be able to pay dividends to equity holders. It wouldn't be able to invest in new property, plant, and equipment, et cetera, et cetera. So it's kind of a lower bound measure, an upper bound measure of how much they could pay off. So Apple, for example, despite being a very healthy company and everything, they would not be able to pay off all their debt in 1 year. Now, that might not be surprising, right? If you get a mortgage, it's going to take you 30 years to pay it off for most of us, right? Nobody really expects you to pay off all your debt in 1 year. That would be crazy. But again, it's just kind of like an analysis of like a worst case scenario. So Apple could pay off 60% of its debt with 1 year of cash flows. And you kind of see it fluctuating, okay? And we'll look at some ratios in a minute that kind of, I'll show you some ratio distribution across companies in a minute that kind of gives you an idea of what's a good ratio, what's a bad ratio. So let's just, though, real quick, I think this is our last exercise. Yeah. Let's calculate times interest earned, or the interest coverage ratio. Let's calculate that for Best Buy and Bed Bath & Beyond and see who's healthier. I mean, I can already tell you Bed Bath & Beyond has negative earnings, so it's not going to look good for them. But okay, so for Best Buy, for BBY, so the interest coverage ratio, we want income before interest and taxes, EBIT, okay? So I'm going to take the net income. Again, that is not always just, you don't just always go up to operating income, because if you just jump up to operating income like we looked at earlier, you're also excluding other gains and expenses, okay? And you don't want to do that because that's not necessarily interest expense. So I like to start with net income. I go to the footnotes or wherever I need to go to figure out what the actual interest expense is, and then I add back the tax expense as it was listed, okay, on the income statement. And then you divide that whole thing by the interest expense, right? So this is going to tell us how many times could Best Buy pay its interest. And if you do that, I probably rounded it a little bit, but you get approximately 122 times. So that's a lot. That's like saying, it probably wouldn't be a good idea, but that's like saying if Best Buy took on 100 times more debt than it has right now, it would still be able to make an interest payment on that. Okay, that's kind of like what that's saying. So they're more than able to, we should not be worried about Best Buy in the near term in terms of being able to pay interest on debt. Totally doing great. What about BBY? Okay, so we start with the negative 560 in net income. We add back tax, we add back interest, and we divide by interest, and we get, unsurprisingly, we knew this was going to be negative, which is always bad. Negative 6.3 times. Okay, so anytime you have negative earnings, clearly you're unable to pay your interest because you're losing money, even as it is. Okay, but I mean, did I say GameStop? Anyway, Bed Bath & Beyond. Bed Bath & Beyond, even if they flip to positive earnings, right? Their earnings are so low, even if they flip to positive earnings, they're not going to have a high interest coverage ratio. Okay, their interest coverage is 65, right? So even if they had positive 65 earnings, they're still only covering their interest once. So that's how you calculate times interest earned. You just add back interest and taxes, divide by interest. Questions about that? And again, we'll look at it in a little bit, in just a second, actually. I'll show you some different ratios and how they're distributed. So in terms of thinking about this, just briefly talk about credit ratings, okay? And so credit ratings, I don't want to get into it too much, but I'm going to show you a big table of credit ratings, so that's why. So credit ratings, right? We've got the big ones are Moody's and Standard & Poor's that rate both companies and company bond issuances, right? They give them ratings of how risky they are. All right. It's kind of, and it's kind of like doing, for those of you that were here for my last session where we did valuation, a lot of the analyses that credit rating agencies do are very similar to what we do when we're valuing equity and we're thinking about making stock market investments. And they do a lot of financial ratios, okay, in their analysis. So we've got Standard & Poor's and Moody's, and they have these different kind of semi-confusing rating schemes. But the general idea is the more A's you see, the better, right? And if you start seeing C's, things aren't as good for you, okay? So the only reason I bring this up is because I stole from a textbook a long time ago. I doubt it's very different now, though, honestly. What we have is here. This is from Moody's, I think. It is from Moody's. Over here, we've got the rating. And so Moody's has given, whoever wrote the textbook has volunteered their data and has given for each bucket, right? So what does the average AAA rated firm look like? What does the average AA rated firm look like? And then over to the right, we've got all these ratios. And I told you there's like a million different ways to define ratios. And you're like, what the hell is all this stuff? But it really is, I've listed up here what these things, really are more or less equal to. So return on assets. Now we know, so AT is total assets. There's also a lot of jargon when you get into like data and research. So you've got EBITDA over total assets. So it's not quite return on assets, but it's earnings before interest and I don't know why it's before taxes, but that's just what Moody's does, right? Everybody does their ratios a little different. But so they've calculated return on assets. They've calculated, this is almost what we just did, right? We had EBIT over interest expense for interest coverage. They've got EBITDA, so they're adding back amortization. That's fine. They've got the profit margin. They've got the profit margin from the DuPont analysis, okay? They've got the debt to equity, a leverage ratio. They've got operating cash flow to debt, the last thing we just learned, okay? And you can see, as you go down the rating scale, you can just see all the stuff getting worse, right? And so the question about interest coverage, right? We saw Best Buy had interest coverage ratio of 122. Is that good? Well, the average AAA rated firm has 17. So yeah, 122 is like insane. Absolutely nothing to worry about, right? You can think about profit margins. You can think about, this is where we talk about, what's a good level of debt to equity? So the credit rating agencies think about this very carefully, and they do an industry by industry analysis and stuff like that. And they really think about what's too high of a leverage ratio. And you can see here debt to, book cap is just equity. Again, another weird way of saying equity. Book cap, just like market cap is market equity value, book cap is the equity on the balance sheet. So you can see you start out 22% debt ratio, leverage ratio for the top bucket. For the bottom bucket, you've got 92.5% of equity in debt. Okay. So anyway, it just shows that that these different ratios we were learning, they're not just important for like if you're thinking about investing in a company, they also are very clearly and closely related and monotonically related to how risky a company's debt rating is. Okay, so everybody out there uses these ratios, just maybe in slightly different ways. Okay, the last thing that I want to talk about is, let me make sure I have it pulled up on my other computer to share the screen. I want to talk about this thing that I briefly talked about at the end of the last session, just because somebody asked about it kind of randomly, but I'd always meant to talk about it in this session. I want to talk about the Benesch model. Okay, so another way that we use financial ratios is to examine if anything looks weird. And that's why I was saying you always compare to something, right? Compare one company to another, or compare a company to itself over time, right? Is it growing? Is it getting worse? Is it getting better? Is it bumping around? But you can also use ratios to figure out if there's any weird patterns in the data, okay? And at some point, different people figured this out and eventually put it into a kind of a sophisticated big data kind of model to figure out how financial ratios could predict bad outcomes or predict fraud for firms. And so, for example, and it uses a lot of accounting intuition, like if a company is faking its sales, right? Literally just making up, oh yeah, we sold 100 million when they didn't make the sales, right? How might we figure that out? Well, if it's a fake sale, then the customer clearly didn't pay in cash because there is no customer, right? And so therefore we might expect to see an abnormal increase in accounts receivable if the sales are fake, right? Again, there's no way to fake cash. I mean, you could lie about that. There actually was a fraud in Germany a couple of years ago where the auditor, who I think was Ernst & Young, I can't remember, the auditor accepted a screenshot of the bank account website. And clearly they went into like Photoshop and edited the screenshot, made it look like they had like a bunch of money they didn't have. And the auditor was like, okay, it looks good. Okay. But other than if you're extremely stupid like that, there's no way to fake cash. Okay. All right. Also, just dramatic increases in revenue. When people are reporting like, oh yeah, we grew 200% every year for the last 4 years. You're like, did you really though? Okay. So, and then also if expenses are going down in a weird way, like how did you reduce expenses? And expenses include stuff like a lot of estimates, like depreciation. And so companies can play all these games like, oh, let's change the useful life of our assets, or, oh, let's switch depreciation methods or whatever. And so you'll get some abnormally low expenses if companies are faking expenses. So I know this looks crazy. You can look at this kind of on your own later if you want to, because you have the PowerPoint. But basically, Benesch went in and looked at all these companies that had been uncovered for fraud versus companies that had not committed fraud, and used a bunch of kind of similar financial ratios to what we've been looking at, but a little bit different because they're all changes in ratios. Okay, so we were just talking about the operating cycle, right, and days of accounts receivable. And so what he's got like his very first thing is this days in receivables index. And so you're just taking all your accounts receivable and dividing by sales. Okay, I mean, I know we did sales over accounts receivable, but it's just the ratio flipped. It's going to give you the same, same information, just flipped upside down. So he's got accounts receivable divided by sales, and then he's got divided by, and he's got the lagged versions, the T-1 last year's. So basically, like, all these ratios are looking at the change from last year to this year and looking at how extreme the change is. And so this is a ratio of accounts receivable to sales. And the idea is if accounts receivable balloons up, right, relative to sales, there's a chance that some of those sales are fake. Okay, that's just the logic behind the very first one. Some other ones, this is the easiest one, just straight up sales growth. It just turns out that really high sales growth is a predictor of fraud because it's hard to get really high sales growth. It looks at depreciation, right? What's the depreciation relative to total property, plant, and equipment? What's the change in that? If all of a sudden the percentage of depreciation dramatically drops, maybe that's a lie, okay? Maybe that's not organic. And then some other stuff too, like leverage. So it turns out that when companies have higher leverage, when they have more debt, they are more likely to commit fraud because they're riskier, okay? And so sometimes they have to inflate their earnings more because they're riskier. Okay, anyway, so just all these different ratios, and he plugged it into this model to predict fraud. And let me switch my screen share here. And Ron shared a website in the chat that supposedly does this for you. And I haven't checked it out, but I'm assuming that works. But there's also this spreadsheet that I've shared in the Google Drive. This is the blank version. And I mean, you can probably modify some of this on your own. You can have up to 4 years of data. And you've got to go to your company's financial statements and just basically find these numbers. Okay. Now, again, some of this is still subject to the same concerns we talked about earlier. So row 7 says long-term debt. Well, remember, for General Motors, they had 2 different long-term debt items. For some companies, you might see 3 different items in long-term debt, right? So you just got to be careful to find all the stuff that's supposed to be in there. Some of it's pretty straightforward, though. Sales, okay, cost of goods sold. So you plug all this stuff in, and you need to plug in at least 2 years, because remember, all this whole analysis is about changes in ratios from one year to the next year. But if you plug in 2 years of data, then over here on the right, it will spit out, it'll calculate the model for you that are based on some regressions that he ran. And then it will spit out an M score, it's called the Benesch M score. That's what it's called, the probability of fraud. And then that M score will be converted into a probability that your company is manipulating its earnings. Okay. Now, this is not perfect. You do get false positives, just like anything else, right? Like any other test in life, you get false positives. But let me show you some examples. So let's see. I got to pull up a different file here. Let me show you some examples. And this was his initial, like, the big thing that made this paper really blow up was his paper came out before the Enron fraud. His paper came out in 99. And so this is if you plug the Enron financial statements into his model. So in 1998, his model was saying less than 1% chance of manipulation. In 1999, when his paper was published, it was saying there's a 2.4% chance of manipulation. In 2000, 29.5% chance. And this is the year before the fraud was actually uncovered. Okay. So this is a test on a company that wasn't even in his paper, right? Out of sample test. And if you had used Benesch's model, you would have sold your Enron stock, right? No one would have had any losses because they would have sold all their stock and tanked it, I guess. Well, the last holder would have had, somebody would have had losses. Okay, so that's one example. let me pull up a couple others that I've done in the past. Oh, our poor alum. Okay, so I think yes, that's the right share. Okay, good. So this is for Under Armour, our poor alum, Kevin, who we don't want to, don't want to be too mean to him, but okay, so this is Under Armour numbers, and in 2000, I don't remember when the SEC initiated the investigation. I think it was I think it was just a couple years ago, but the SEC alleged and concluded that it was true, and Under Armour ended up paying a penalty for manipulating their earnings. And guess when Under Armour manipulated their earnings? According to the SEC, who actually investigated it, 2015. Okay. And so the SEC determined there was fraud there, and they said it ended in 2016. And you can see the model. The model says the same thing. The model says, yep, it looks pretty good after that, but some sketchy stuff was happening in 2015, right? All right, I'm not gonna, I have more examples. You can look at them yourself. There's Groupon, there's Alibaba, and for each of them, I've noted the year that either a fraud was uncovered or the SEC investigated or whatever. But you'll see that it's done a pretty good job. And I've also used to assign this to students. I'm just going to reshare my PowerPoint here. I used to assign this to students to do in their final project for one of my classes. And so I've seen a lot of these done. And it doesn't turn up positives that frequently. Like, so it's not like, oh, every company is a false positive. I've seen hundreds of student stock pitches, and 95% of companies, it doesn't turn up any really substantial chance of fraud. So it's not like everybody's a false positive. All right. So when the last slide, I guess, is, so when is it, what's too high? When should you start worrying? Okay. Is there any threshold in this model? That's what I'm about to cover right now, Evold, if I said that right. Great question. That's the next slide. When should you worry? Okay. So his original paper did a bunch of different analyses. So the question of when you should worry, it's not totally clear, because it depends on, it's kind of like calculating, how much should a company charge you for life insurance, right? It involves a bunch of complex things, include the probability that you're going to die or get sick, and how sick will you get. And that's the same thing with frauds. Some frauds end up not right. Under Armour manipulated earnings, they're still alive, right? There was a stock price drop or whatever. Enron manipulated earnings, hundreds of billions of dollars lost, right? And so he had to go back and figure out what's the average cost of a fraud, right? And so you have to make some different assumptions about how expensive is a fraud versus your opportunity cost of not investing in the company, right? So the nice thing about this model is there's a really simple prescription for avoiding fraud companies. You just don't invest in them, right? And so the cost to you of not investing in a fraud company should be fairly low, because you can usually find another company in the same industry, right, for your portfolio. So the cost shouldn't be super high of not investing. So anyway, based on these assumptions, he basically says the M score that you should start worrying is somewhere between negative. This M score is usually negative, and it gets more and more positive as the probability of fraud goes up. But so negative 1.96 and negative 1.78, which shockingly to most people, you should start worrying at about potentially at as low as 2.5%. If you want to be a little bit more liberal than 3.8%. But notice 2 years before the Enron fraud, the model was already saying 2.4%. Okay. But so yeah, that's the general recommendation, is somewhere between 2.5% and 3.8 probability of fraud. You should just not invest. And again, the reason is because if you do get caught in a fraud, you're going to lose a lot of money, probably a big percentage of your investment. And if you don't, right, if you don't want to invest in Apple, invest in Samsung, right? It's stuff like that. So that's kind of the idea. All right, cool. So that is, oh, do I have something else here? Yeah. So just, yeah, don't invest, basically. I've already said what's in this text, is that it's not very costly not to invest in something. So that is I guess we've ended a little bit early, but I'm okay with that. Again, I've never taught this mixture of materials in a solid, whatever, a 3 hour and 45-minute session. But I will post the videos. Actually, let me stop recording at this point. Well,